Morgan, BlackRock, DTCC, Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it. He finally said it.
I'm so bullish.
Andy's bullish. I'm bullish. We're bullish. We're going to the top.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the roll-up.
The institutions aren't coming, they're simply here. It's the golden age of crypto, guys. Get right, let's go. Welcome to the nest. See you on the show.
And we're live.
Guys, I'm sorry. I'm so sorry.
No, we're not going to start there.
Arthur.
We're live from the CT
Arthur
Digital Forum. We've got a lot to talk about today. We're not gonna just bear all day. That's not what we're here for.
We promise. You know, all my homies hate Arthur Hayes. Okay, we're live from the CT Digital Future Forum Fest in Stamford, Connecticut, UCONN campus. First time I've been on a college campus since 2019.
CT does not stand for crypto Twitter. It stands for Connecticut, and we are on the campus of UCONN. They've got some fast Ethernet, and we're gonna be talking to a lot of very, very smart people today. Yeah. Very excited.
Across an array of topics. So
and then we've got robotics, we've got AI, we've got digital assets, of course.
Yeah.
So we're going to be getting into it.
Yeah. Good morning from Lakeland. Good morning, Kevin. Good to have you. We've got our first guest here, Zach Pandel of Grayscale, the head of research. Grayscale recently launched their hyperliquid ETF. I think it was yesterday. It's definitely seen some great flows. Obviously, you guys have been tracking this with us for a while on the show. We're going to get Zach on, and we're going to talk hyperliquid. We're going to talk what's going on in the market. Last time Zach was on, he addressed this as a crypto cold front. The winter seems like it's coming. Let's see what Zach's got to say. Zach, welcome back to the show. Great to have you again.
Hey, great to see you guys. Great to have you in Connecticut. Grayscale, of course, home base is Stamford, Connecticut. So you're here visiting our home turf. Great to be connecting here.
Absolutely. Zach, you've been making a tour. We saw you in Miami. We saw you speak all over. You've been to the tokenization tower. There's trials and tribulations in the market, but what is it? What is your reaction? You're coming home. Stamford, Connecticut is the Grayscale headquarters. How does it feel to be here in Connecticut at the CT Digital Forum?
Yeah, look, we're having fun in the market today. Of course, Bitcoin is down. We're happy to talk about what's happening with the majors and MicroStrategy and all that kind of thing. But there's so many things that are flying, so many innovations in the industry, regulatory clarity, really driving a change for our institutional clients. So we're busy, we're activated, we're investing for the long haul, certainly no let up whatsoever from Grayscale. And I'm happy to talk about Hyperliquid and all the new things coming. But I think it's a really exciting time for working in digital assets and running a digital assets asset manager, even if price is down for some of the big tokens.
Definitely. Yeah. I mean, we saw this really interesting market bifurcation that we've been talking about as of late. You've got a couple of these assets that have been, performing very, very well. A lot of flows seemingly go into them. And then like kind of majors were at this point of like, kind of just like chopping around. Last couple of days, we did see a bit of a pretty strong pullback all majors. And then like this relative strength trade kind of unfolded overnight. It seemed like, at least that's what our audience is going to say. When it comes to kind of viewing how the flows have changed in the market, right? Like, I think the big question has been, we used to live, or we still do live in a Bitcoin denominated kind of market where everything follows Bitcoin in this way, and the flows have been very concentrated, basically on like Bitcoin being like this risk on or risk off, kind of like a barometer for the market. And that's just changing now, it seems like. Flows are coming from different vehicles, from different places, people with different time horizons, et cetera. Are we still in a Bitcoin denominated market firmly? What's your take on kind of like how the flow structure in this market is changing?
Yeah, I don't think we can totally escape the kind of gravitational pull of Bitcoin. It's still a huge share of the market. Most institutional allocators, really, they still only have Bitcoin, and they're beginning to dip their toe into the platforms that power stable coins, tokenized assets, decentralized finance. So these are what your audience would think of as the other majors, Ethereum, Solana, BNB chain, the kind of major smart contract platforms. That's where the institutional allocators are today. But I think with this, what you guys have called the three-headed dragon, and I have taken that term to heart as well, near, of course, Hyperliquid, Zcash. I think what's happening here is that allocators are bringing a new discipline to putting capital to work in crypto. It's just not buy any random large cap token. It's find the things that really are new innovations, driving real value to the token holders. I think those are three great examples that are obviously leading the market today. And I think we'll continue to see that, more of a selectivity among allocators and really innovative ideas rising to the top. I think it's a healthy thing for the crypto ecosystem to see that differentiation trade playing out. You guys have been on top of it, and your audience, I think, very well up to speed. And I would say Grayscale, also very in front of this. We are the only fund manager that offers investment products in all three of those things. As you said, a Hyperliquid ETF launched this week. Shout out Hyperliquid. But we also offer a Zcash product, a Near product. So certainly all these assets near and dear to our heart at Grayscale, and it's been a thrill to see them really get the recognition they deserve.
Yeah, and it's been incredible to see Hyperliquid surge into the top 10. It feels like there are still some assets that are in the top 10 crypto coins out there that don't really belong there. And so we're seeing this uncorrelation in the market. We've seen other cycles, things all go up at once, they all go down at once. This is fundamentally it feels different this time, which is kind of funny to think, but it really feels as if there's this period in the market now where things are starting to separate. What do you also see it that way? And if so, what do you attribute that to?
Yeah, absolutely. There's two things, regulatory clarity and revenue. These are the two things that are changing all the conversations that we have with professional investors. These are the regulatory clarity allows them to look at the asset class in a new way, and it allows other institutions that are building, say, using stable coins to engage with crypto. So that's changing things from a fundamental standpoint. And then revenue, and the revenue flowing to token holders, I think, is a way for people to reconsider the way they think of crypto. And I can't overstate how important Hyperliquid has been in that regard. Of course, Near, an important part of that story, new revenue, driving that to token holders. But Hyperliquid, I think, really stands apart as a very transparent use case, something that traditional Wall Street can understand, something that generates revenue and passes it back to token holders in a very straightforward way. So that clean value capture story of Hyperliquid plus regulatory clarity, those are the things that are really activating institutional allocators that we engage with regularly.
Yeah, man. So I had a dinner with the Bitwise guys a couple weeks ago, or even it might have just been last week, and they were saying that it's actually much easier to talk about Hyperliquid as an investment vehicle or as an opportunity than a lot of the other crypto assets that they have ETFs for. I think their ETF has been one of the largest that they've ever launched in terms of speed. When it comes to explaining the value proposition of crypto assets to institutional allocators, you mentioned these, two things: regulatory clarity and revenue, or just positive kind of like fundamental flows. How different is it explaining crypto assets outside of Bitcoin that have real flows and a real kind of business model versus like the traditional L1s or kind of like infrastructure, projects? I'm not saying that those are like any worse or any better, but how different is the conversation of like the kind of rabbit hole of understanding when it's just like, here's the cash flow, here's the business model, here's where it goes. How much different is that conversation?
It's a complete unlock, and our approach has changed, I think, now that we have these types of products and ETFs that give access. What we tell allocators is that there are two types of crypto assets. There are things that look like commodities and things that look like traditional financial claims like stocks and bonds and are based on revenue. You think about valuing and allocating to those assets in different ways. I think people completely get that. And I think traditional allocators will come around to understanding the use case of Solana, Ethereum, and Bitcoin, but maybe they will come in the back door, essentially, through the kind of revenue generating projects like Hyperliquid and build to Bitcoin over time, which I continue to think is one of the marquee assets in the financial system and an extremely important asset and technology, providing digital scarcity and a level of security that is unmatched within crypto. So people will come around to the Bitcoin vision, but cash flows, discounted cash flow valuation approaches, these are how most financial analysts and capital allocators start. So Hyperliquid has become an excellent on-ramp for those types of users.
And the other thing was, from their team that I kind of heard was that it's not that these buyers right now from the institutional side are price insensitive, right? They're always trying to look for a deal. They want to find a right place to get into some of these assets that are like these mega trends, tokenization, perps, stable coins, et cetera. But they're much less price sensitive than like the average trader or investor from like the crypto native land. How accurate is that? Are these investors coming in and being like, look, we see perps and tokenized assets trading 24/7 is a mega trend that's going to happen. We look at CME and NASDAQ and all these platforms and we see that they're going in this direction. We just want to kind of hop on board and be a part of that and not kind of like miss that opportunity? Or like, what is the appetite of kind of like urgency in allocating to these mega trends?
Yeah, I would say they are price sensitive, but they have long horizons and they're allocating capital for a big structural trend that is expected to play out over, say, 5 to 10 years, not 5 to 10 weeks. So they're planning for the long haul, but they are price sensitive. And I think that, if I had to, explain why people may hesitate on Hyperliquid, just because the prices run so much. When we were at 40, the multiple was at one level. It's a different kind of multiple when you're at 70 or 80. So that price difference will matter, but they're planning for the long haul. And I think a longer-term horizon allocator, they're focused on not only revenue, but the durability of that revenue to competition and the potential to grow that revenue over time. And those would be the tough questions that'll be asked about every project in crypto. Not just have you made money in the past, but can you sustain it? What happens when other big competitors join the market, and how do you find other vectors for growth? Those are the types of focused questions that we're getting from allocators.
Yeah, Zach, we know you only have about 2 minutes left here before you end up on stage and give it a talk there. So I want to play a quick bullish, bearish. Don't want to pigeonhole you, but there's plenty happening in the market. Hyperliquid, obviously is the topic of focus today. Perps regulation going live. People have said that could lead more competition to go live in the U.S. Also, Hyperliquid could end up in the U.S. Bullish or bearish for Hyperliquid perps regulation in the U.S.?
Look, it's incredibly bullish. Don't miss the train here. The train on perps and Hyperliquid is leaving the station, and I think most allocators are at risk of missing it. This is an extremely innovative platform that is providing a compelling product in a highly competitive space. Futures trading, speculative trading offshore. This is a highly competitive market. Hyperliquid is leading that growth today. I think the CFTC changes are the first step to getting full access to the Hyperliquid platform in the U.S., and there will be a second step around decentralized exchanges that comes together over the next couple of quarters or so. But I think that Hyperliquid is coming to the U.S. Market before too long, and that'll open access, of course, to many more users.
Got it. BitMine launching a preferred offering at 9.5% yield.
I'm going to reserve judgment on this one, and I want to see what they're going to do with the proceeds and also how this fits in the context of ETH staking. I would expect a change to Ethereum's staking model in the not too distant future. And I think we're going to see a lot more discussion about that over the coming months. And so if the reward rates are coming down, how does that fit with Bitmine's ability to pay the coupons? What are they doing with those proceeds? I want to see all that stuff. But look, I think Tom is a great operator. I'm optimistic on the Ethereum ecosystem. I looking forward to seeing what's happening there. I think Bitmine will be a great contributor to Ethereum, broadly speaking, over time.
And we've seen some great research coming out of Grayscale on the Ethereum staking model. Arthur Hayes selling hype, selling near, and you've got to get on stage, so I don't want to hold you up.
Look, I'm a fan of Arthur. I think he's an exceptional trader. Our approach is a bit different. We're trying to pick the winners, again, not for 5 weeks, but for 5 years. And so we're still in all those trades, of course. And I think Arthur will be back in those trades.
I think so.
I think so too. Zach, thanks
Zach.
so much, man.
Cheers, man.
Really appreciate it as always.
See you guys.
Have a great conference. Cheers, man. All right, guys. Well, Sailor's down 11.5 billion. Lee's down about 9 billion. Where did it all go wrong, Rob?
Well, Bitcoin doesn't have a native staking model.
At all.
So there's only one way only to fund an 11.5, I think it's 11% or 11.5% dividend in the stretch product, which saw an impressive amount of volume and interest from investors. People came in, they loved the 11%, but it's difficult to fund that because you're only doing it based on, the appreciation of the Bitcoin price.
Yeah.
Ethereum's different. It has staking in it.
But they will try to lower the yields.
Yes.
They're definitely try to lower the yields.
And so I would think that Tom Lee wouldn't have to sell as much ETH to fund the dividend because he's already got revenue in Bitmine. He's using this yield
What
as
is
revenue
Stretch
rallies.
trading at, Rob?
Passing this along.
What
and
is
so
Stretch trading at? Ooh, it's back up today.
Yeah.
96.
And I think that makes sense because Saylor has shown that he is willing and able to sell Bitcoin to fund that dividend. But of course, this comes with complications in the underlying Bitcoin price, and it kind of fractures the flywheel that he has built and he has talked about. So we'll see. We'll see. Our next guest,
John Woo. Let's go, man. Let's go. We are in the institutional era of finance, ladies and gentlemen, here at the CT Digital Future Fest at Stamford, Connecticut, UCONN campus. And John is a leading voice for institutional asset management, digital assets, and more. Guy is dialed. Surprised he's not in Paris this week at Proof of Talk. I saw John was there, or a separate John.
A different John.
Different
Who
John.
works for me. Great guy.
John's the president of Avalabs. Pleasure to have you on the show.
Pleasure to be on the show.
John,
You
cheers,
guys do
man.
a great job.
Thank you, man.
Thank you.
Rob,
Yeah.
Andy.
Cheers.
Yeah, thanks for coming. Avalanche's leading tokenization. We've had the pleasure of hosting Olivia on the show multiple times, multiple people from the Avalanche ecosystem. We just covered her article on the national best bid and offer and some of the evolving tokenization market structure. So John, just curious, what are you most excited about? What are you most focused on as it pertains to Avalanche tokenization and the CT Digital Forum today?
Yeah, the CT Digital Forum was fantastic. Great group of people. Always nice to come out here from New York because the crowd here is a little bit older. They definitely understand traditional finance, and then they're really appreciative now of DeFi and crypto. Not so much 2 or 3 years ago. It's a little bit of lag, but this is what's great about this crowd. What I'm most excited about is a whole bunch of things that's happening on Avalanche. Like 7 years ago when we started this journey, we were first of all 10 guys in a room. Now we're like over 200, and we always wanted to have the enterprise or traditional finance come on chain. So we built it thinking we're going to have DeFi, crypto native, but we also want to just get the enterprise on. And now this is actually happening. So it's one of the subject matters out there on stage was it's kind of bittersweet because blockchain's gone from think of it as crypto asset speculation to real enterprise technology. Yeah. And 0 to 1 is over, and now it's 1 to 10. And that's a lot of blocking and tackling. But I'm excited for all the real world activity and not just the tokenization of an asset, whether it's a commodity, security, or a collectible, but making that asset productive, having continuous yield and making it more in the spirit of what DeFi was supposed to be.
Yeah, man. I mean, we've been trying to shadow this kind of like mental model of we've built this industry for this collective of, a couple $1 trillion of total market cap, $150 billion of TVL in DeFi, to like, no, we have, hundreds of trillions of dollars of assets in the world that will be coming on chain. May take 5, may take 10 years, may take longer, but the entire complex that we're building here is so much larger than kind of, I think, what any of us perhaps initially thought when we set out. And so I feel like Avalanche has done an incredibly good job of like being very in the loop of like the early DeFi days, all the DeFi things and NFTs and the community building and all of that. But then very, very quickly realizing that the future of this industry is in this enterprise, institutional grade, blockchain based company. And it's kind of an interesting world right now where we're in like this blockchain, not Bitcoin era again. I don't know if you're around in 2018, but that was kind of the entire thing. ETH is going through its own like Ethereum, the blockchain, tokenization of stablecoins, but not ETH. And I think that there's a lot of that kind of rhetoric. How do you like reconcile the broad bullishness and adoption that's happening with Avalanche versus the kind of detrimental, downright like despair that people are feeling about token prices and about kind of like the market? How do you kind of like balance these two things?
Sure. I mean, it's a changing of the guard. It's that simple. I mean, you used to have very retail crypto native people, and that's great, and you need them. They were the people who got this whole movement started, and we, want to keep servicing them. But if they want those original retail people, it's now moved to more an institutional base from an ownership perspective, from a usage perspective, and the next big thing will be from real world assets that are usable, collateral, basically can move it around and use it for more than just, okay, the right of ownership is on a blockchain. So I think once you do all of that, and you put those pieces together, the original crypto native person is suddenly going to be saying, wait, if I can take Apollo's A cred, which gives me 8% yield, and use that as collateral, and then loop it or do whatever you want in a more easy, user-friendly fashion, they may appreciate it far more. But you have to go through this, bumpy road to get there.
I'm excited for a time when risk-free is obviously a very relative term, but we're not getting a half a basis point in our savings account in interest. We're getting the 8%, or we're getting upwards of 10% at a neobank because we're leveraging some of these composable benefits of tokenized products. And what does that world look like? Stable coins have kind of gotten this, this funky territory where we could see some capital flight. At least banks would have us convinced that that could happen. Ultimately, it almost feels like that's bullish for our industry because it speaks to the size and scale of what we're building here. How do you think that world shifts as more of these products come on chain and more of the banking landscape sort of reconfigures itself?
The vision is to have what I call continuous yield. And we get paid, our checks come in biweekly, right? So in theory, we're accruing value, but we're not getting it and we can't put it to work, and therefore we're not getting the yield associated with that. And there are reasons for it. Obviously settlement is one reason. Stablecoins can move that down a lot. Then there's really just administrative paperwork. Like someone has to take the taxes out, your employer has to figure things out. There's real stuff that has to be done, but it shouldn't be biweekly. And the vision is one day, and probably more on a blockchain than not, because it's, if things move easier, is that you're going to get a check at, maybe it's 2 weeks, but you're going to be able to accrue that yield, continuous yield, or maybe you can get it into your wallet even sooner. And then you don't need these payday loan areas that are usurious rates and all of that stuff. And then the whole world just changes. It allows the velocity of capital to happen. It'll take a lot of people who live paycheck to paycheck in a world that they don't have to go take out loans to just feed their families or buy some TV or something. It's going to improve the lives of a lot of people. That's the vision. That's where we want to get to. It's not going to be easy, but that's where we've been working on.
I mean, you're talking about a $10 billion industry. In 2022, borrowers took out more than 20 million payday loans, totaling nearly $8.6 billion. It feels like every week we discover this new pocket of the traditional financial system, and it's another $10 billion here, another $1 trillion there. And we're just chipping away at these pockets of value that ultimately come on chain. And those add up, those compound. And then the world looks a lot different.
Well, I mean, you already talked about neo-finance. Neo-banks have been really big for the last 10 years. Using stablecoins and agentic payments one day, that's still a little bit away. It only accelerates it what you're saying, what you guys are really into, the whole neo finance. But you need to have all of those primitives, and you need to have accessibility. And again, the blockchain is actually a very good place for that because it's immutable and it's visible. And if you have and it's composable. So if you have all the primitives, and I'm not talking about technology primitives, I'm talking about the apps all there for people to plug into, or pieces of an app. And once that happens, like, far more entrepreneurialism can happen, and faster.
Yeah. I have a question about value accrual, because we are in this, okay, we can take the $8.6 billion, payday loan industry on chain. We've had a number of conversations. We had Joseph Shalom on the show talking about this with respect to ETH. We had Donnell from Stellar talking about it with respect to Stellar. Obviously they're making a wave into RWAs, and continuously we're hearing this model where, okay, there is some strength and the value proposition is very strong as it pertains to the technology. This is helping real businesses. We're moving these things on chain. And those are billion-dollar, potentially trillion-dollar industries. The value accrual to the asset, it's such a contentious topic. And I'm just curious, if you want to speak to Avalanche in particular, feel free to, but in general, the model seems to be, we want to scale these things so that we're ready and we can support lots of adoption. But if we scale these things, it's such that we're not charging very much for these transactions, but then the asset is accruing value based on the transaction fees, and the transaction fees goes to zero. These things feel very counterintuitive. Can you just help us square this circle?
Yeah, that's a great point. And I think the space in general is trying to reconcile this. There's a tension here between a traditional revenue model and a traditional equity company that gives you a service, gives you something or product, and gets paid in either a fee or a percentage per transaction, or monthly, like a SaaS type of thing. That's the traditional world. These things were built to not be a company. They were built for a permissionless open ecosystem. And the token was supposed to be a function of many things, whether it's like utility in the sense of gas to use the open source technology, or for governance and many things. But when you try to square a circle, it is very messy. And what's happened is basically you have token economics in the early generations of these systems, if you will, these blockchains, networks, that effectively, algorithmically predicted the supply on a regular basis. It's really hard to figure out the demand side. So I think some of the legacy and all the layer ones from previous generation, we started in 2019, and so did Algorand, Polkadot, Ethereum's our earlier generation, Solana was during our generation. We all have to figure out what it really is going forward. For the longest time, I think the inorganic demand, like extra demand, was able to eat up some of the organic supply. Now, it's the AI bro, not the crypto bro, and some of that. So we have to figure out how an organic system will work well in a permissionless manner. And I think a lot of us, I know I think about this all the time for Avalabs and Avalanche, there's got to be different token economics. We've seen this new group of people, called Hyperliquid, who've done it well, and they have different twists on it. There's a lot of big buyback, through a treasury that they have, and those are the things that you can do to create, a better system. But I think right now, I think all of us are figuring it out as to what's the better system.
And I mean, like, a lot of this value is, you guys are doing work in Latin America, and you guys are, onboarding thousands and thousands of people to different neobanks. And we were talking, to Olivia about the work that you guys are doing there on payments and stable coins, et cetera. And, a lot of this is happening. So there is, like, it's actually quite funny. You could argue that the token valuations for a lot of things in the early days were far inflated comparatively to like the value that they created, and now it's going the other way, where companies like Avalanche are going out and creating tons of real world value, and then now the token market is kind of like the question mark. And so it's kind of interesting how like the pendulum has shifted from like not producing a lot but a ton valuation to producing a lot, and now the market's kind of like, well, you're still not good enough. It's honestly just not an easy spot to be in, and it's not a fun conversation. And we got yelled at by the Stellar people for asking them the same question, and so kind of getting away from the token side, John, what is the brand breakthrough for Avalanche here, right? Like, Hyperliquid has done well in the sense because they went and like they were trading non-crypto assets. You can think of other platforms in the space that have done well because they're kind of like broken out of the little industry. What is Avalanche's trading commodities 24/7? Gary V, NFT. What is Avalanche's like moment or like brand breakthrough that's gonna like kind of like let it eclipse the small subset of users and institutional clients, maybe in the States or in the crypto community? What is Avalanche's breakthrough?
All right, so before we go to the brand breakthrough, I want to finish and address the previous question.
Okay,
so
yeah.
prior to running Avalabs Avalanche and being an operator, I was a tech investor. And one of the things I always looked at was hidden value in companies.
Sure.
So Avalanche, as a reminder, is kind of a network of networks. There are many layer ones or purpose-built blockchains for different companies and all over the world. And they can easily tie back to the main chain, and it's interoperable with the main chain where more liquidity is, and then also they can tie into any EVM compatible. So it's very interoperable. And that's why all of these enterprises want, to be on Avalanche. It's because they have their own tension of control versus interoperability. They want the interoperability and they want the innovation on the permissions world, but they have regulation and they have compliance, so they have to have control of who's in it. So the hidden value is there is all of these layer ones that are tethered to Avalanche.
Right.
That is effectively proof of authority chains. We have this thing called Pragmat, 2.8 or almost 3 billion in Japan, 3 billion of tokenized real assets and real estate and securities. It's going to be on a private network. There's similar things like that elsewhere. So it's a lot more real world assets doing things on Avalanche that is not known to anyone else because it doesn't pop up in an Explorer because it's private right now.
Yeah.
But they will be one day. So what we're focused on is how do we connect all of these different layer ones to each other, and how can that accrue value to the Avalanche token, and ultimately, the system, the flywheel will go effect. The way I look at it is, the interesting thing about this space is if you look at a traditional balance sheet, you have your assets on the left, and then you have, debt, and then you have equity.
Yep.
The token in this space is actually both an asset because you need it to do things, and it's also equity in some sense. So, and obviously balance sheets have to net to zero on one side to the other. So when one goes, the other side has to go, then that's the flywheel. And it's good when it goes up, but it's also very bad when it goes down. Mm-hmm. So we're thinking through all of this, but on the asset side, there's a lot of, hidden value right now in Avalanche. And once we unleash it, things will go much better.
I'm curious to hear more about this Japanese, private.
Do you want me to answer the brand thing, or do you want to go to this thing?
Man, and we're gonna go wherever we want to go, ladies and gentlemen. So I'm happy, man.
So according to RWA XYZ, there's $1.6 billion of RWAs on Avalanche, but you're talking about a $3 billion Japanese real estate and RWA private C chain that is on
private chain. C
private
chain is,
private chain on Avalanche. Can you tell us more about this? Like, and you're describing it as private for now, implying that it's going to become composable in public later on. And so, tell us more about this, because I feel like this is probably flying under the radar for most.
It is definitely flying under the radar because we've done a lot of things overseas in Asia, and the rules and regulations are different there. What they want to do is take advantage of the efficiencies of having the asset, the registry, on a blockchain. We're doing that here in the U.S. as well. You definitely get benefits from just cost savings and reducing and automating, so reducing the number of manual steps to keep track of things. That's their first step. But they're also going to marry it with, also think of it as stablecoin, which is, they have to decide which stablecoin. And then ultimately, all those assets can trade far more in a free manner. And that's ultimately their goal, to unleash the velocity of the capital associated with those assets.
And real estate for so long has been such a locked asset class where it's very difficult to get liquidity. At the same time, we're talking about emerging markets quite often on the show, and how a lot of people are excited about the thought of investing in tokenized U.S. equities because this is a great asset class, U.S. equities. But also there's emerging markets all over the world. We've talked about the Korean stock market and some of these things as it pertains to the AI trade. But there's also real estate abroad, and people are very, very excited about getting into this as well. And I think another thing flying under the radar here is that tokenization implies the ability to not just invest, outside international investors investing in the U.S., but U.S. investing in emerging markets and opening up new asset classes as well.
Absolutely. Like, obviously, the rage is AI trades and memory stocks right now, right? So I can buy Micron very easily. I can buy SanDisk very easily. It's very hard for me to buy SK Hynix.
Right.
Very hard. So unless you have the right brokerage that has access to that, you're hoping there's an ADR. And usually if there is an ADR, it doesn't trade that liquid. So if there was a tokenized version of SK Hynix or Tokyo Electron in Japan or one of these other companies, I mean, think about how easy it would be to tokenize that and make it like we have Denari does that for what you said, basically. They take US stocks and mostly it's used outside, where outside people get access to Apple. The reverse can also happen, if that's what you're saying.
Shout out to Denari, proud sponsor of the show as of a couple of days ago.
The only pushback on the real estate tokenization is that we had Carl from 6 Man on the show like 2 weeks ago. He has
Carl's
this tokenization spectrum. Basically, he's claiming that there's like a spectrum of value that tokenization brings to a set of assets. And on one side is like tokenized deposits and stable coins for obvious reasons that I think all of us know. And then on the other side, it was more like highly liquid, volatile assets that mark to market every minute, every block, every second, whatever it is. And in the middle of like the barbell that he's kind of claimed that wasn't so interesting was things like private equity and things like real estate. And he said that because tokenization applies this framework of instant liquidity, instant redemptions, ability to get yield, ability to kind of get in and out of products, amongst other claims, that it has less value for real estate and private equity. These investments are much longer term and they're marked to market once a quarter. What would you say to that?
He's not wrong. He's actually right about that. Let's just take the real estate example. I've been in this space forever. You guys have been in space for a long time. Real estate's always been talked about because you can fractionalize it, you can trade it easier, and it's illiquid right now. But then why is it not happening? That was like the first use case for tokenizing a real world asset, and it's now been like 15 years since I've heard it, and it's not happened.
I do remember that.
So he's not wrong. The liquidity side of that argument has not come for whatever reason. However, that's only one way to think of creating value by tokenizing that piece of real estate. You can go and get a mortgage when you go buy a house, right? When you have art, that's a different type of real estate. If you're high end, you can go to certain, call it asset wealth managers, and they will take your art as collateral. That real estate, once it's tokenized and you put it into and make it a productive asset and put it into some pool or some sort of borrowing capability, suddenly you turn that real estate and make it productive. And that's a function that exists in Web 2, and now it can also exist in Web 3.
Yeah. And I think, part of the neo-finance thesis is that these DeFi protocols are built for crypto native assets initially, but are targeting the broad spectrum of potential tokenized assets, real estate included, and going all the way through that barbell. And we are starting with stable coins. We're going down the risk curve and continuously tokenizing more of these assets. And HIP-3 is a great example of this. They've done so with, starting with gold. Oil is getting a lot of traction there. And now we anticipate, and this is maybe an unpopular opinion, but we anticipate that RWA trading, HIP-3 trading is going to outpace volume and an open interest and general activity on these chains beyond crypto native tokens. Do you agree? If so, how do you prepare a blockchain to trade predominantly non-crypto assets?
So I actually hope that happens because that's the vision we all wanted to take these unproductive assets and make it more productive, or less productive assets, make it more productive. So how do you prepare a blockchain for that? Well, Hyperliquid is as much a product as it is a layer 1 blockchain. Mm-hmm. They've combined the whole stack, if you will. There's going to be many different types of assets. If you look at the stuff we're doing in private credit, you need to have so many pieces of that. You need to have the origination. You need to have warehouse loans. You need to have a servicer to make sure, administrate all the payments and the data flow of that. And you need to have the end, lender. So you have to have, it can't be just, trading purposes. You have to create the life cycle of private equity or life cycle of the asset. And that's what we're doing at Ava Labs and Avalanche, for Avalanche, is making sure that we have OFI, which is effectively the originator of the loan. We're going to have someone who aggregates the loan, basically sourcing it, lead generator. You have a Fence, which is basically the servicer, just like a traditional in Web2 finance. There's a service out there. Yeah. And we have Valinor, which is a fund that actually goes in the ultimate buyer of the stuff, or lender, if you will, in the credit world. So you have to have all of these, I call it financial, operating, and regulatory primitives. It's not just tech anymore. So how do you prepare for it as a chain? Well, you have to have those non-technology primitives on chain so that other people can come in. I was just talking to this guy at Dealport, and they basically do a lot of financing for old school businesses. They're going to think about coming onto Avalanche to see if they can help their old school manufacturing businesses get, financing. Another thing I have to mention is we work with FIS, Fidelity National Services. They're a $25 billion publicly traded company. They work with a lot of community banks. Intane are working on top of Avalanche to make it cost effective so that community banks and small businesses can now do CLOs and can originate loans that they could not have done before because they don't have the scale like a large Bank of America or Wells Fargo. And suddenly they could possibly come on chain also and connect to all of these other financial and operating primitives that we're talking about creating. So I think it's far more than just trading that stuff. It's also creating the underlying primitives so the whole cycle of the asset can function properly.
Just to kind of close that,
capital formation.
Someone in the audience says, digitizing and tokenizing real estate is a massive undertaking. I don't see it happening anytime soon. I think we probably agree it's going to be a process. The other thing I think is a bit more kind of like on the nose for you. You tokenize your home, effectively turns it into collateral that can be used to get credit from any willing participant. Basically, it's gambling chips, LOL.
No, you get a mortgage. Is that gambling chips as well?
or a HELOC, right?
Or a HELOC, and that's already happening.
Yeah.
So I think that's nothing new. I mean, if you start trading it, it could be gambling.
Yeah. John, thanks so much for coming on.
Pleasure.
Have a great
absolute
conference,
pleasure
John.
as always.
Pleasure to meet you as well.
Yeah,
I think it might be the first
pleasure.
time.
Yeah.
And thanks for joining us. Have a great conference. Please go spread the word to all the tech, robotics, AI investors about Avalanche, about digital assets and what we're doing here.
You guys doing a great job.
Thank you, man. Yeah,
Appreciate
love to have you in the tokenization tower next time.
Definitely.
Cool.
Yeah.
Let's do it. All right, John.
Beautiful.
Yeah,
Oh, yeah.
absolutely.
Guys, we need a
We
little
brought the
Polaroid here.
Polaroid.
Sweet.
There
Love
we
that.
go.
Polaroid, old
Let's
school.
go.
I love it. You guys do a great job.
Thank
Thanks,
you so
John.
much.
Cheers,
Appreciate
man.
it.
All right, guys, how we feeling over here? How we feeling? How we feeling out there in the quick little check-in here?
Yeah, let's check in.
Hype sitting at 67. BTC fighting for its life. Near fighting for its life.
World coin God candles up 12% in the last hour.
Dude, so Arthur literally dumps on
He
everyone.
dumps hype and near and says he's going to hold his
The
world
WorldCoin
coin
and
till
then
the
sends
SpaceX
WorldCoin. Dude,
IPO
this
and
guy-
pumps it.
Dude, we had the chat firing. OG Killa says, you can't hype something, then 4 days later dump it because you know your 3 reasons that everyone already knows of already. It's pump and dump simple. People are not happy with Arthur right now.
Guys, are we holding? Are we holding in this market when people are calling for Bitcoin in the high 30Ks?
I mean,
35 to 45K is what I was.
Yeah.
I got a text last night. I was watching the Knicks game.
Go Knicks,
not gonna,
man.
Not gonna tell you who sent me that text about Bitcoin going to 39, 38, 37 and a half K.
Guys.
I doubt we get there. Look, if you are looking
you
for a little
doubt
bit
we
of
get to,
hopium.
like 40s or 30s?
No, I think we get to 50s. I think
Okay.
maybe we get to 40s. I don't see us going below like 43, 43.5. I don't think we get to the 30s.
Okay.
I don't think we get to the 30s.
30s would be crazy.
30s would be super crazy. Our quant is saying that
I think
emotional capitulation is sort of happening.
Yeah.
I think another 40% decline on Bitcoin from here would be beyond capitulation. I don't see it happening.
It's hard to say. What also is annoying is that we were all in this like relative strength positions, right? And those just got blown up overnight. I saw a tweet that was like people hiding in relative strength and get hit by a truck. I don't think that we've been hit by a truck quite yet, but in these moments, I don't know. I just pull up the hl.eco dashboard.
I think we have to ask ourselves the question with Bitcoin in the 40s, let's say. It seems like that's sort of, a consensus we're orbiting around. Is potentially we get into the 40s. I think if Bitcoin gets into the 40s, how does Hyperliquid react? How does Near react? How does Zcash react?
I don't know.
If Bitcoin gets in the 40s,
I mean, we're gonna get some good discounts across the board there.
I would imagine if Bitcoin is in the 40s, Hyperliquid's in the 50s.
Yeah, for sure.
Right? I mean, I don't think that gets unreasonable.
That would be great if that's all that we got to.
We've gotten uncorrelation, but we haven't gotten divergence. Right?
We kind of had it.
We had it for maybe a little while, but now this is bigger. This is showing ourselves that we haven't quite. It's not like Hyperliquid has pumped to new all-time highs as a result of this most recent Bitcoin dump.
No, exactly. If that happened overnight, that would have been insane. Because it was happening. Like, I was already at the bar at the next game. Bitcoin was dropping 64, 63. Hype was just staying at 75. And
I think this is
OG Killer says you're a true optimist.
Me?
I agree. Rob is a true optimist.
I am. I'm an optimist through and through. What, are you going to live your life? I mean, we've got one life. We're going to live it. You're going to live your life sad and pessimistic? No, I'm going to choose not to see it that way. And so I'm going to choose to see it optimistically. But look, calling for a 50% decline in Bitcoin is an optimistic point of view. Then I think that now is starting to become the time to buy. If 40K Bitcoin is an optimistic point of view, I think everyone else out there is a little bit afraid.
Yeah, I mean, a 33% discount on Bitcoin from here takes us to low 40s. I say that's about as worse as it's gonna get.
Deep as we go. I think 50s for Bitcoin. I think we're gonna see some support along the way. And I think ultimately this is going to take some time to bottom out. Obviously, we've got the midterms coming up. But, one of the things that Arthur said that didn't really occur to me until just now is very counter and contradictory to the way that things are typically done. Normally, you pump the market going into the election cycle.
You're right.
One of the things that Arthur said is that he anticipates Trump taking an anti-AI stance to pander to Democrats and anti-AIers and using that as political leverage going into the midterms to try to get some political clout and win some of these, Senate and Congress elections. That would crash the market. Yeah. I mean, if Trump takes an anti-AI stance, and obviously AI
There's no way Trump's doing that.
AI is indicative of tech as a whole. Crypto gets bucketed up into that as well.
Easily.
We would see markets decline, which is typically not the way that things go when we're headed into an election cycle. But I could see it. I mean, it makes sense because there is a massive anti-AI cabal out there. Yeah. What is the chat saying?
Just wait until we see Michael Saylor get liquidated, in the words of Dokon, steady lads. If Bitcoin hits 40,
lads deploying more capital. I don't think Saylor has more capital to deploy.
If Bitcoin hits 40, all of MSTR products would implode and would be ELE.
Okay, but look at what's happening to Stretch. Stretch is actually bouncing and it's headed back to, like $1.
Where is it at now? Stretch is at what?
Back to $100 par.
That's what we need. I mean, that's what Saylor needs bad.
If Stretch maintains its peg, gets back to $100, that is going to restore confidence in MicroStrategy. And it is going to feel weird that Bitcoin goes down, but people have more confidence in MicroStrategy, not MSTR, but in MicroStrategy, because Stretch isn't going to completely implode, which is going to be healthy for that, that business and that portion of the Bitcoin ecosystem as a whole.
Yeah, I mean,
which would allow him to potentially save this, the billions that he's raised through this product. People wouldn't be, bankrupting and suing him right off the bat. It would allow him to potentially raise more debt once Bitcoin kind of gets going again. But he's in deep water. We're in for some tough times.
But it was always on the cards.
On the horizon.
Chris's tweet of people are going to blame Saylor, but it was always on the cards. I think that's pretty accurate right now.
I mean,
People
it's
are
not
already
just-
blaming Sailor.
Right. And it's not just Sailor, right? But it is fueled in part by Sailor.
This feels just like Terra Luna. Yeah, I don't know. It's not that bad. I don't think. I don't think it's.
It's
I don't
certainly
think
not-
it's like it's not that endemic to the industry.
Yeah,
right?
I mean, it's endemic to the Bitcoin capital formation, capital structure right now.
100%.
And Bitcoin is systemic to the rest of the crypto industry.
Yeah.
So yeah, I mean, in that sense, it sort of is. I think we have to unpack the relative strength trade. I think it's no longer, relative strength is kind of level one. And I was talking about this with a partner of ours, actually, as we were kind of thinking through like this inception sort of, idea and how these ideas get brought to market. They get done in levels, which coincidentally aligns with the way, the movie Inception, how they go deeper within the subconscious of this person. They go level one, dream, level two, dream within a dream. And so as you go deeper in here, you kind of get level one has been this relative strength. Okay, it seems as if this cohort of apps are showing some relative strength against the quote unquote majors. I think level two of this is how uncorrelated are they? Are they uncorrelated such that they're holding up better in the face of, deep major downturns? Or are they diverging? And I think now we're starting to see this unfold where now would be the time for them to diverge, man.
Yeah,
this is when we would want to see that. It is still relative strength for them to hold up a little bit better. And if you just look at some of the larger time frames, Bitcoin's down 12% in the week, Ethereum's down 10%, Hyperliquid's up 17% this week.
Yeah, so it is divergent
Zcash
if you
is
zoom out.
Zcash
but
is up 2% this week. Near is up 2% this week.
could
WorldCoin is
look,
up
though.
103% this week.
Jesus. You could see yesterday, like I was way too zoomed in, but obviously like you're trying to track this positions and this trade. And you could see yesterday, like Bitcoin started going down and then hype didn't really like explode when it bounced on the hourly. And then it would kind of come back and then have a 4-hour bounce and hype wouldn't really go. So you could kind of see it starting to break. Per, on the other hand, only down 4% today. Knock on wood here for Shamus.
Hyperliquid's only down 6.8% today.
I got 9.5. I got 9.8 on TradingView here.
I got 7% on CoinGecko.
OG Killa, I lost a Lambo during Luna. Damn, bro.
Shout out OG Killa.
Barely made it through, just a bit. Please, Jeff, don't F this up. I agree. Anchor
WorldCoin continues to surge. I think that's what we're going to see. I think the market is telling us that we're going to have very, very select winners.
It's
and
such
not
short
everyone.
term, though.
But if you think about how the market reacted when Bitcoin was holding up, when it was just staying still at like 65, you started to see market going into a broader swath of this cohort.
Yeah.
Meaning, obviously Hyperliquid, Zcash, Near, VVV were the leaders in the privacy, revenue, and AI categories. Those, I think, are the categories that are showing relative strength. Whether we're going down, they will hold up better. And when we're going up, they will outperform. I think that's the relative strength trade. Hyperliquid, Zcash, Near, VVV, revenue, privacy, and AI. When Bitcoin was holding steady, we started to go deeper into those categories and get a broader swath of assets in those categories that started to perform well.
Yeah.
When Bitcoin goes down, we're going to get consolidation in those categories. It's still going to be those categories, privacy, revenue, and AI, but we're not completely untethered from the majors. We're
and I just think it gets worse when Bitcoin makes new lows.
When Bitcoin makes new lows, those cohorts are going to consolidate, and potentially it could consolidate so far that zero coins in those categories make it through okay. Right?
ICP, guys. Oh my gosh, Marcos, please, bro.
Get out of here with ICP. We don't want to hear that.
Hey, let's pull up the screen. I just want to show you guys this. I mean, I don't know. It's not that comfy right now, but if there's anything to stay comfy in, it's this TWAP chart. And I think it might be Shamus smashing this right now.
So
I think Shamus is looking at the TWAP and he's like, look, man, we need this thing to keep this trend. I see $15 million next 24 hours. We're still waiting on.
No, we got the data.
No, I think that is old.
This was 6 hours ago. They
just published.
They published that they
Can
bought
we pull that up,
1.4.
please?
I'll send you the link.
I'm gonna get the hype strat.
They published that they bought Let's get it
That's
going
why
here.
they're up today. I mean, they're not up,
But they're
not
relative
down.
strength. Relative strength. And we're going to see this in multiple stages of the market. So
If
let's
Hype's
just
held up, man,
let's just-
Per
let's
would
just-
be at $12.
let's just describe what's happening here with Hyperliquid Strategies. They published that they bought 1.4 million Hype. That's worth
Yep.
around 95 million over the last 7 days. And their cash position only fell by 15.5 million. So they bought 95. They only used 15.5 of cash, or they only lost 15.5 of cash.
Yeah, that's because they
and
issued
exactly.
or
They issued
or
stocks,
they tapped their credit
or they
facility.
tapped their credit facility. They were able to raise more cash,
Yeah.
which is effectively the same thing that when Strategy was raising cash with Stretch. They were able to get investors into this ecosystem, whether that means products that are funded by dividends produced by the asset itself, or it means that they have investors that are willing to invest into the stock. They're able to raise cash. They're using the cash in Hyperliquid Strategies case to buy Hyperliquid. And so what this is telling us is that they were able to raise at least $80 million over the last 7 days because they bought 95 and their cash position only fell by about 15.5. They're still around that 1.29 MNAV, which allows them to issue more ATM shares, sell them, and buy more Hype.
Yeah.
So
I've got that up on the screen here now as well, and you can see the Hyperliquid Strategies financial metrics.
Yep.
And on the screen, you can look at their current value of their holdings. Let's go ahead and get this up if it's not. And you can see the value of their holdings, the cash holdings. So it's that 141.7 million. They've got about 1.5 billion or 1.6 billion in Hype. And they cash from financing. Trying to see if you can
Jim
see.
Cramer says Michael Saylor murdered Bitcoin.
Wow. So the MNAV is about 1.22. The last update was this morning, guys. And so I think that's probably why Per is outperforming a little bit today amidst all this. Type set 777 says a meme coin. We're not buying meme coins. The guys are fighting in the chat about ICP. Sold a Bitcoin to go into Hype last night. Don't rug me, Jeff. Dude, I don't blame you. I mean, like, reading a script, Marco's, all right, guys, let's keep it all cool. If you want to own ICP, you can own your ICP in peace, man. Everything's all right.
Sold a Bitcoin to go into Hype last night. Don't rug me, Jeff.
Feel you on that, man.
Man.
I honestly think that's going to continue to happen. So,
Selling Bitcoin to go into Hype.
So, I mean,
That's going to help the relative strength trade.
I would consider this a win for Hyperliquid Strategies this week. Not as big of a win as last week. Last week was like a major, like, we sold the top. We have more cash and more Hype now.
Wait,
like,
when you say they sold the top, they sold their equity, right, to raise cash? They sold ATM shares.
Yeah, they sold Per to raise cash.
Yeah. So they're not selling Hype.
No.
Never that. Man. What do you think about Bitmine issuing the $300 million of preferred equity, the 9.5% rate?
I
Irrelevant?
just think the timing is not great.
I think if they're able to complete this raise, then we're going to look back on this and it's going to be a great move.
It would be like a bottoming moment for them. They just they have so much work to do to lower their cost basis. So much work to do.
Yeah.
Coming back to HIP3, pulling this up. I mean, open interest just continues to rise, continues to hit new highs across the board. I mean, it looks good. This is like the main story right now. If you heard from Capital Flows, he was telling us that, sure, it's down a little bit from yesterday, like 200 mil or so in open interest. But the main story was Hyperliquid's diverging from the market because a lot of its revenue is getting, derived from trading non-crypto assets. Robbie's looking at the WorldCoin chart.
This thing is insane. You're talking about, you think this is the main topic right now. WorldCoin was at $10.
Yeah.
You remember when this thing was at $10?
It was at $100 billion FTV at $10.
It's at 59 cents.
Unreal. Wow. We got some pretty important 4-hour closes. Not that the show is going to turn into a 4-hour trading show, but near at 100 unreleased. Says still up massively on my THYP position. Agreed. Absolutely insane learning about ore yesterday. Yeah, I agree. You missed ore yesterday, but it's a $50 million market cap asset trading at a $45 million market cap, fully diluted, 1-to-1, trading at with $50 million of revenue in less than a year. So its revenue is literally outperformed its market cap, and it is unknown, tackling privacy, quantum, kind of all in one. It's pretty incredible. Pretty incredible.
Man.
What are
we buying? I hope you guys have some cash. I'm getting feisty around these levels. I'm getting
on Bitcoin.
Yeah, like, Bitcoin at like 50s, in the 50s. Like, I'm definitely ready to start nibbling on that. I think we do go. I could see hype in the. I think if Bitcoin gets in the 40s, hype is in the 50s. Near's under $2, but like maybe not by a lot.
Yeah.
I don't think we go that, like, even hype at 50, I think people are going to be calling for a lot lower. And there's going to be people and that's going to be a great entry. I think hype in the 50s,
yeah, if we get it,
is a reasonable entry. If we get it, I would be bidding there. And I'm honestly excited because I don't think they stay there for long. I don't think Bitcoin goes down. Maybe, but how, when our quant says that, usually you don't have a lot of time to sell the top, but you have a lot of time to buy the bottom, right?
Yeah.
Because you have
not the exact pico bottom, but
right,
we're
like
gonna have
apathetic market conditions over the next few months.
We're gonna have a period of weeks to months in the range of like $5,000 to $10,000 that you'll be able to get into Bitcoin. It is exciting because it's like, as every day goes by, we're closer to like the 4-year cycle, typical October lows, and now at the worst case, let's call it we're 4 months out. We're 4 months out.
So I think I'm finally going to start taking our own advice as it pertains to the show. Anytime someone comes on here and says this time is different about anything, I'm going to just
fade it,
fade that. Nothing is ever different.
Yesterday, the vibes on CT was full on. This time is different. Like
nothing is ever different.
Full on. Full on.
I mean, 4-year cycle. We had hype flip Sol and price, which. What is Sol doing right now? Are we still flipped?
It's in the 70s. No, it
re-flipped.
hype. Isn't that terrible? It's on. Let's give some love for Sol coming back to life there.
Man. So, look, I think hype and Sol. Yeah, Andy wants me to shill his bags while I'm up here solo. I don't know if I can do it. I think we're going to get hype in the 50s. I think Bitcoin's going to get into the 40s. And I think we're going to end up in a position where we're going to get some good entries here. We also had Jorts on the show, who was telling us that this time was different. And I think we're just seeing this play out in the market where this time is not different. The 4-year cycle is playing out. We're getting closer to the mechanisms that we see play out every time. Guys, we are going to get ready for our next guests. We're going to do a quick standby, guys. Don't go anywhere. And we're going to bring up our next couple of guests, chatting a little bit about robotics. We're going to branch out today, not just about digital assets today, AI, robotics. This is the great convergence. We're seeing privacy, AI, digital assets across the board, and we're going to include robotics in that. Don't go anywhere right after this.
money, power, I'm big, 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 but I'm big. I'm right big, 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 but I'm big, money, power, I'm big, 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 but I'm big. We get deep, you know we get deep. You know we get deep, we get deep, you know we get deep. We get deep, we get deep, we get deep, you know we get deep.
Guys, we are back here with Cal and Randy of the New York Robotics Company, and I'm excited to be talking to you guys because this is something we don't cover too much on the show, but this is one of the mega trends that we're seeing for this great convergence. We're seeing it happen across finance, AI, robotics, hardware is becoming part of this revolution as well. Would love just a bit about your background before we get started. And then I think there's tons to dig into as we think about how robotics is going to play into some of the converging disruptive technologies that we're seeing play out.
All right. Yeah. First of all, I'm with a company called Batchery. It's a AI startup studio. We're doing robotics now as well. The size of the AI market is actually 1/4 of what the physical world AI could be. And so that's where the convergence of robotics and AI happen. So literally everything we've seen with AI, 4x it for the potential size of the market impact. And even like Hendrickson Horowitz said, this could well be the largest market to tap into ever in the history of investments.
Yeah, it's incredible as we think about the market size, and I think there's knock-on effects of this as we think through the market impact of bringing all of that to market. Randy, if you don't mind, New York Robotics, co-founder, managing partner. Would love a little bit about your story, how you found robotics.
Yeah, well, I am the director of strategy and operations, actually, not managing partner at New York Robotics. Just to make that correction, New York Robotics is it's a nonprofit organization, and it is committed to being part of the deep tech ecosystem in New York that's making New York a global hub for robotics.
Yeah.
My background, I started my career programming robots. I had an early experience at an AI startup, which was 30 years ago. That startup didn't make it, but I ended up acquiring some of its assets and starting my own consulting company. So when I ended up selling the consulting company, I looked back on the beginning of my career. I liked the sort of tech portion of it and got back into robotics. How I found New York Robotics was a meetup group. My co-founder had started a meetup group to sort of bring together a fragmented community in New York, and then we incorporated, and now we are over 5,000 strong.
Awesome. We are updating your title as we speak on the show.
Wow, you guys are fast.
Guys, I'd love kind of a general picture of where we are today, because for so long we were in this software revolution. We were operating in the world of bits. Now we're operating in the world of atoms, and robotics is the leading edge when it comes to the world of atoms. Obviously we hear quite a bit about humanoid robots. I kind of saw the Boston Dynamics, upwave of the enhanced capabilities that these things have. I hear Elon talk about the hand and how difficult it is to engineer. And I hear about China and the apparent lead that they have on the US as it pertains to the robotics industry. Can you guys just kind of highlight maybe some of the most prominent misconceptions? Just kind of level set us here. Where are we today in the robotics revolution, and what are some of the most important things to be focused on today?
So historically, we have always led in R&D, and we continue to do so. We have sadly lagged when it comes to actual deployment. And you talked about China. We've studied China extensively. They now lead in dark factories that are basically run by robots, where literally the lights are off. And their workers inside those factories have a productivity advantage over our factory workers by a factor of 2.4 to 1. So they're almost 2.5 times more productive today. And we're kind of seeing that trend continue to something like 10 to 1 advantage. So we're starting to see some impact of that. Let's say, for example, EVs. Some senior executives, the CEO of Ford, visited one of the dark factories, and frankly, they were scared. They are terrified about how far behind they are. We have our Teslas here. Because of tariffs, we don't see the Chinese cars. The BYD cars, if they were to come here, they would be 25 to 50% cheaper than like an entry-level Tesla Model 3. So we're playing catch-up. I don't think the race is over yet. We have plenty of opportunity to catch up, but we do need to form some sort of national strategy as best we can on how to catch up to China and surpass them, particularly in sectors like advanced manufacturing and defense.
Are our regulations here in the US holding us back? And is that why we haven't progressed to the point where we are on the same level or competing with China? Because now, those results will start to compound. Is it, this coherent, consistent philosophy that the Chinese have to band together around national priorities and focus on them? Is that what is driving this? Or is it US regulations, bottlenecking us and slowing us down?
You want to take it, Grant?
Yeah, I'll take that one. What's driving, you're talking about what's driving the gap in competition between
exactly
China.
the advantage that the Chinese have in robotics.
Yeah, after World War II, we started outsourcing manufacturing. And we, at the time, were manufacturing 95% of the goods consumed in the United States, here in the United States. Now we manufacture 5%. The people who are in my children's generation don't even know the language of manufacturing. They can't speak to it at all. So what's driving the competition, what's driving us being behind, is the fact that we outsource the entire industry to China and elsewhere. So that's the...
And why did we do that?
Well, I think it started out as, you know, the winners, if you will, the Allied powers, trying to find ways to drive the economies throughout the globe. But I think it proceeded to service careers and other careers being more lucrative and people wanting to do them more than manufacturing. And obviously what was driving it, a huge part of driving it, was the cost of labor.
Yeah.
You know, so you saw 3 or 4 times lower cost of labor, sometimes 10 times lower cost of labor. You asked about misconceptions, though.
Yeah.
It is a misconception that we can't compete with China. We need to try. And I think we have, perhaps, maybe it's provocative, we talk a lot about it and about how far ahead they are, but I don't think we're trying hard enough. And I think Cal alluded to national strategy. I think that's just part of it. But another example of it is that it's very hard to buy motors for robots in the United States. So every builder will say, oh, you got to buy your robots from China. The reason it's hard to buy motors from the United States is because nobody's making them. But there's no reason we can't. And so I think that we need to just take some of the steps sort of on the ground, right, while we're also creating a national strategy, while we're also figuring out how to finance what is ultimately going to be potentially a huge movement to reindustrialize here in the United States.
So this is a national priority. We've heard a lot about the reshoring of American manufacturing and industry. How are we doing on that timeline, and how sustainable is it, given that, you know, there are some more unique policies that are put into place now with the current administration, and in America, things change every 4 years, every 2 years, you know, when it comes to not the president, but, you know, the rest of the government. And those priorities sometimes shift with the changing, you know, regime. What are the through lines potentially that from administration to administration we can carry through that maybe everyone agrees on, because they are such no-brainers, they're so obvious that we need to keep those in mind, irregardless of who's in office, and that can help us close the gap? What are those things that we can keep in mind?
Yeah, I kind of agree with that in the 1960s, John F. Kennedy said, you know, in the next decade, we will go to the moon. And we had that moon mission.
we did, yeah.
And we had that Northern Light, and we accomplished that goal. Times are different. I don't think we will have a national moon mission equivalent today from the government, but we are seeing movement from our business leaders. Jeff Bezos has announced he's doing like a $100 billion fund for advanced manufacturing, completely done by robotics. So business leaders are doing it. Similarly, Randy and I were just talking about JP Morgan has announced something like a $1.5 trillion security and resilience initiative focused on a number of industries, including robotics and related industries, specifically for moving the economy forward and for the national security. So we're in a little bit of a different environment now, that there are different players doing it. And whoever it is, for the sake of our country and for national security, we should be doing it. And I think there are roles for Randy's organization, my organization, and so forth. And honestly, it will take a village from all aspects of going from idea to market launch and scaling. And I think that's the direction we need to take.
Major forces that are going to impact reindustrialization. Defense. We are using robots in defense, and we have conflicts going on throughout the world. And conventional wisdom is that those conflicts are going to increase. There's going to be, over the next 20 years, more need for weapons, and those weapons are becoming increasingly automated. So you have robots, air, land, sea, and space in defense. In the United States, you're not allowed to build robots and weapons with Chinese parts.
Right.
But we are building them with Chinese parts because we need the parts and we can't get the parts from any place else. And the reason we can't get the parts from any place else is what I was talking about earlier. It's because we've given up our manufacturing base that can build them. That is coming back. This force of defense and national security is massive. And that is part of what's driving it. There's also a lot of venture capital now going into manufacturing. They're looking for areas where fully automated manufacturing, particularly, can disrupt industries. What else? I think labor is actually going to be a big force that's affecting this because there's such a huge labor shortage in manufacturing. So there's a reason to automate because we can't find the labor to do the jobs that are necessary. But the labor we don't have is the labor to repair the robots. And the scale of automation that is necessary in order to meet the national defense needs, meet the reindustrialization sort of flow that's happening back in the United States, it's huge. So we're going to need people who know how to repair robots.
Right.
And as I said earlier, the generation, my kids, they don't know anything about manufacturing. Mm-hmm. They don't know how to fix a car, right? And so people who do are going to be in high demand as we increasingly automate.
Yeah, and I think we're seeing that play out as, people are increasingly, young people are starting to, go to college less. They're starting to realize. I wasn't watching it, but the person next to me on the plane, I happened to peek over, he was watching the news, and there was a study that said 52% of people with college degrees regret their college degrees because of either loans or chosen career path, this sort of thing. And I think more young people are realizing what you're saying, Randy, and they're going into these career paths that they can get into. They can take an apprenticeship or take some sort of trade and use that to extend their potential earning power and potentially more sustainable. And I think that attitude, if they can continue that as that career shifts, they will retrain with the emerging technologies.
And they're good jobs. Mm-hmm. So it's worth doing. May I address a misconception?
Please.
Mm-hmm. Because earlier so I talked about the misconception that we can't compete with China. Right. I mean, people will argue with that. Certainly, we're not going to get lithium batteries back because there's a rare earths issue. Not being able to compete with China is a misconception, but there's more to it than simply saying you got to try harder, which is kind of what I said earlier. But another misconception is the capability of these robots, particularly humanoids.
Yeah.
I saw a recent video from a company that is teaching humanoids to box.
Okay.
I saw a video where a humanoid started to jab. A jab involves sort of your hand and your foot moving at the same time. Something happened, and the humanoid's foot spun all the way back in ways that our legs and joints would never do.
Right.
And it put its foot right through its own pelvis.
Ow.
And that happened within the first 10 seconds of trying to start this fight. So humanoids aren't anywhere close to where people think they are, where people imagine that they are.
I didn't think you were
and
going
there.
They
aren't anywhere close to where a lot of the big tech leaders are claiming they are.
Right.
And it's a wild misconception.
And it's still so early, and I think you're pointing at something where maybe the production capacity of China is advanced, and it is. They have advantage as far as how many humanoids they currently have in production in these factories, and factories are using them. But to your point, these are not perfect robots by any stretch of the imagination. And I think it's fascinating to think about what capabilities we can add onto these structures, both hardware and software, to make them not only better, smarter workers, but also just more capable physical embodiments give them a third leg, give them a third arm, give them these structures that are more specific to the purpose that they're being built for doing, both intellectually and physically.
I think you just hit the nail on the head, because it's very narcissistic that we designed the humanoids after us. And we are not the perfect form factor. Let's say, for example, picking up a box. So if you're just saying the job to be done is picking up a box, you would invent a very different device. Similarly, for years now, we've had the Roomba. The Roomba does not look like it's not going to become better by having a humanoid now pushing a traditional vacuum cleaner. So I think the winners will be the ones that invent the technology that works best for each use case and scales accordingly. And you did say also humanoids in the dark factories. I don't think it's the humanoids. It is more the mechanical arm manufacturing robots. And those are the ones that will create much more economic output than the humanoids. I think especially the generation we have now are more charming toys to play with.
Yeah. So, yeah, please.
I mean, there's two sides to this. And I love what you said, because there are an awful lot of sort of purpose-built robots, and there still needs to be. Even as robots learn how to do different tasks and decide what those tasks are themselves, there's still a necessity to do certain tasks really, really well in order to automate. So a lot of people who are talking about sort of pushing back on humanoids are saying, why the human form?
Right.
And is being a narcissist bad, by the way? But they're saying, why the human form? And what about a quadruped with a hand? What about 3 legs, as you said? Absolutely spot on. The other side of the argument is that robots need to be in the human form because the world is built around the human form. Right. The other part of that argument is that foundation models need to be built for motion and behavior that don't exist now, that would drive AI, physical AI,
right.
And the most data you can get is from humans.
Yeah.
And so what's happening is you have companies that, we have one company that has a $200 million Series A. And what they're doing is they're getting data out of video games where the video games have human forms. And they're taking the data from those human forms to create foundation models. And there are projects all over this world that are sort of combining to create foundation models for the human form.
Yeah.
And so there's two sides to that argument. Like ultimately, does AI need foundation models, and it does, and where you're going to get them? You're going to get them from humans because there's trillions. There's not trillions. There's
that many
hundreds of
data
billions.
points. When you combine video game human, form, video characters in video games, there could potentially be trillions.
That's exactly. But this is what's happening. Like the immersive experience, the data coming from the immersive experience, which so many of us have from either virtual reality or gaming, that there's a lot of innovation going on to take that to scrape that data. And there's also a lot of innovation going on to put sensors around in order to actually capture, the motions of human beings. So there's a considerable, I don't know how much, but a considerable amount of venture money going into that problem of creating foundation models for motion. And of course, NVIDIA is wildly dedicated to it as well.
Yeah. Yeah, I see this trend playing out, how we have technology that is accelerating, and it's accelerating faster than some of the natural technology, if you will. Like the robotics physical form is accelerating faster than our natural human form is. Eventually, we will catch up at par. Then we can get really creative, and we can have a lot of fun with, and I want to get to that with my next question. The same is happening with the intellect of these robots. The LLMs, discovered that we can put numbers into language, and that is the most, because we built that with our human, intellect, that is the most digestible form for this data and this technology for us to use it effectively. It was really, really dumb. Now it's really, really smart. There's an argument that potentially it has found par and accelerated past, and now we're in that really creative and fun, discovery of what is new now because we've surpassed what we naturally, kind of found when we were able to reach the pinnacle. Eventually, I believe physical forms with robots will reach similar par and beyond. My question is around the R&D, the strength, because as we zoom out and thinking from a competitive philosophy point of view, let's not play the China game, right? Where they're mass producing and they have massive manufacturing power. They're able to put these things and really, really churn them out. But because the quality of these robots is not equal, and our game in America is R&D, that feels like our edge. That feels like we're able to out-innovate, and potentially maybe we only have 10 robots for every 100 that the Chinese have. But if those 10 are that much more capable, that much more performant, they can, they don't kick themselves in the nuts every time they try to throw a jab. They're able to throw some real combinations, right? Whereas the Chinese are still lacking. That's where we're able to outperform. Is this the edge? And if so, where are we able to innovate? Where are you seeing the most innovation happen on the R&D front, such that we can potentially, and we're not going to get away from manufacturing and actually producing these things, but where are the levers that we can pull where we can really out-innovate and ultimately win this race?
I first of all, I love what you're saying about the role that the United States could play being to push the outside of the technology envelope as opposed to the race to the bottom in China. I think, though, that we're a long, long way away from truly being able to think like that.
Okay.
So
it feels like we've gotten there with the LLMs and the brain of these robots.
Well, but I think that you're making a very solid point about LLMs and what they did for language, sort of serving as a model and inspiration for what you can do with motion and behavior. But where the research and development is there. It is about how do you create foundation models for motion and behavior. And you have to also consider that, when we type something into whether it be Gemini or OpenAI or whatever it might be, or ChatGPT or whatever it might be, if we don't like what it sends us back, it's no big deal. If the foundation model for behavior translates to the behavior of a robot and that robot doesn't behave well, that's a big deal.
Yeah.
So the challenge is way higher, right? The bar is higher. And that very much is where the research is. But the research is also in actually making robots behave the way that we are imagining they behave. And again, you repeated something I said. I didn't say it exactly the way you said it, but we actually have to realize the ability for a humanoid or any other robot to be able to perform the way it's expected to perform.
Yeah.
And when you put AI into the equation, now you're suggesting that a robot is going to be able to make its own decisions and be able to perform the motion and have the behavior that is necessary for self-determination.
Right.
And the research to actually make robots that are capable of doing that is also where the edge is.
And you're right. That is necessary before we start really using our imagination to think about how we can use them better. They need to be reliable. They need to do the things that we're asking them to do without messing up.
I will also say one more. I'm so sorry. One more thing. I don't think challenging the race to the bottom is a bad thing.
Okay.
I think we can build a $35,000 humanoid to compete with Unitrees. So I don't think it's bad to try that.
Yeah.
And I think it's necessary. I think where, again, the real, in my opinion, where the real challenge is in rare earths, and having the rare earths to build the things that are necessary in order to compete. And I think, again, we have a lot of it. We just haven't mined it. And so it's, again, a matter of just trying. Sorry,
I just wanted to go back to what you were talking about, like the research and development. And that is definitely something I think we should lean into, because we have the great universities, we have some of the great minds. So it's not any of the products that exist today. We will never compete with consumer electronics or things like that. Let's focus on advanced manufacturing, the new emerging technologies. And I think those are the ones that we have invented a lot of stuff over the centuries here. Lean into what our strengths are.
Yeah.
And just what are the things that have not been invented yet? I think that's where we can definitely lead.
Yeah. Guys, the last question I have for you, and this has been a fantastic conversation. Really appreciate it. We talk a lot about capital formation, emerging markets, both domestically and abroad. There's a lot of capital flowing into these areas. Where are you guys allocating capital? Where should we allocate more resources to ultimately move the needle the most as it pertains to robotics?
I'm going to give the first crack. So one thing Randy and I have been working on, I do startup acceleration, running startup studios. We need more robotic studios. We need to be at the universities, collaborating with them, with the innovators, the technologists, the ones that have that next generation of technology, and help them find that path to commercialization. It's those fast-moving innovators that then could be coupled with legacy corporates and forge a better, faster path to market. That's my personal belief, where there's a huge untapped market.
Yeah.
I completely agree with Cal. One of the places where we have to put capital is in building more successful robotics companies. And this plays into some of the conversation we have had previously, because we need to help those robotics companies understand that the components they need are available to them in places where right now they're not looking. And you need acceleration and venture studio and programs like that in order to do that, because the entrepreneurs are under a ton of pressure to as quickly as possible build what they can. So they'll take whatever's on the shelf. And there are things on the shelf that they might not be seeing as easily, and we also are that's developing. But I think the area where capital, one of the areas, really needs to go is into deploying more robots.
Yeah.
So maybe this is a simple equation. China's deploying 300,000 robots a month. We're deploying 30,000. Is it a month or a year?
A year.
Yeah, sorry. So we're deploying 30,000. So let's deploy more robots. Mm-hmm. So how do you put capital into deploying more robots? You put capital into the medium-sized manufacturers that can transform around automation. You have to teach them, help them understand what the business case is, and then have available to them the services that are necessary to actually deploy the automation. We can do that. We develop those programs, put capital into advanced manufacturing. We will end up deploying more robots, and that number will start to look a little more like 300,000 versus 150,000. Yeah. And I do see capital already going into that.
Yeah. Guys, thanks so much. This has been fantastic. Like I said, we don't talk about robotics too much, but this is a mega trend that is playing into the convergence of so many disruptive technologies, and it feels as if now's the time. This is a race, and we're accelerating towards the convergence of this. And you guys have been fantastic here. Really appreciate it.
Thank you.
Thank
It's
you
fun
for
to talk
having
to
us.
you.
Absolutely.
Yeah, a lot
Thank
of
you so
fun to
much,
talk
guys.
to you.
We're going to do a quick standby, guys. Don't go anywhere. We are live from the CT Digital Forum, the Future Fest here, talking digital assets, talking robotics, talking AI. So we'll be right back.
Money, power, I'm big, 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 but I'm big. I'm right big, 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 but I'm big. Money, power, I'm big, 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 but I'm big. We get deep, you know we get deep. You know we get deep, we get deep. You know we get deep. 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 We get.
Alrighty, guys, welcome back to the CT Digital Future Forum Fest, or some version of those words together. We're here in Stamford, Connecticut at the UCONN campus, joined today by Detective Hogan, talking digital assets fraud, Tinder swindlers, dating scams, pig butchering, and more. Detective Hogan, how's this conference treating you? How's everything going?
It's awesome, man. This is I've been to the last one. This is the second annual, and I've gone to the monthly ones, and it's just they have great sessions here. Really good.
Fantastic.
Good crowd.
Yeah.
Yeah.
This is the most diverse crowd I've seen. Like usually you don't see like an investment banker type of people at crypto conferences.
Yeah.
And this one you get a lot of, you have New York coming up, obviously, and we have Connecticut-based Stanford people. So it's a really interesting mix of people.
Definitely, man. Well, I mean, look, man, I can't help my curiosity but to understand what is happening in the dating scam scene. My interpretation is from that Netflix documentary, Tinder Swindler. The guy is just like siphoning off money from this woman or vice versa.
I didn't see this.
Never shows up.
It's a good move, yeah.
Yeah, and so what is happening in the dating romance market? What is the fraud that is happening online now?
Unfortunately, it's not U.S.-based, which would make it a lot easier. Right now, it's transnational organized crime groups sponsored by like China, but for the most part. So we're seeing everything from mostly based out of Southeast Asia, Myanmar, Laos, Cambodia, especially. And they're just attacking everyone. Doesn't know age demographic. People think it's like primarily seniors, which it is heavily senior-based, but we're getting people 30 and up that are getting scammed out of millions of dollars.
Wow.
Yeah.
And what's the usual?
How does it go? Like if
You guys
and
have gotten
I-
it already. You guys, have you ever gotten a text message before? Hey, bro, what are you doing this weekend? And you don't know who it is?
I get these all the time. They're trying to like hire me for stuff.
That's part of
There's
it.
all kinds of things.
Yeah.
It feels like we get a call. At least the calls say spam risk. The texts
No.
are once a day at minimum.
Yeah, so the ones that you'll get a lot of times, the job ones are
Yeah.
based out of the same scam compounds a lot of times. So when you're thinking about these pig butchering scams, you really got to think about like a CEO-based type of scam where you have like a crime boss and you have layers. You have people creating domains. You have people writing script for apps. You have money launderers on the blockchain. You have a whole host of those. And then you have people who are texting you those messages too.
And so you co-founded the Connecticut State Police Cryptocurrency Working Group. So most of these things are done through, is it Bitcoin? Is it crypto? Is it, do they go on the blockchain? How do these things typically go? Like, we get a text.
Yeah.
I'm an elderly person, or I don't think that, it is, I think that it's a real thing.
Right.
And so I respond and I kind of fall into the rabbit hole. What does
Yeah.
the rabbit hole entail?
So it's a months long scam. So their goal, this is long plays here. They're not the quick fix kind of things that you get like a Nigerian type of thing where they just pop up window scam and they just tell you to go to a kiosk and throw some money in it. These are long month plans where they build rapport with you and they move you from fiat to crypto by usually onboarding. So you'll wire or ACH money in from your bank to an exchange at the US. So it feels legitimate. But then you interact on the DeFi web browser within one of those wallets, and they bring you to a scam website that's an investment page that's built by the scammers, and it interacts just like you would with a normal investment page. But they provide you with the wallet address to send funds to. But you're looking at a UI that looks legitimate. You're seeing fluctuations in the market. You're getting returns. You actually get to withdraw money for a little bit to build the reality of it. All the while you're talking to someone who's built that trust with you. So over the month period, you start dumping in like, all right, $1,000 maybe I get a little return. 5,000, I'm getting a nicer return, and then at some point you're pulling a HELOC on your house, and then you find out your ass is.
And they're convincing us that they have like a signal group or something that they have some opportunity for us to make money.
Yeah.
It's not just, this girl is
They're in our
catfishing
YouTube
me and
comments
then
all the time, man.
Yeah.
It's like I was struggling in the markets. I'm a senior. I'm 56. I've been trying to trade, but it's mostly been tough. But then I found Kara Escobar, and her guidance has been elite.
Yep.
And then there's like eight YouTube comments under it that are like social proofing, that are like, yes, Kara made me this much money. DM her on WhatsApp or hit like, Kara did this for me. And it's just like
Explodes.
We always have to delete these comments on our videos.
Yeah, you get, unfortunately, you blow up Meta for that, because I feel a lot of them are Facebook or Instagram based ones, and then we get a lot of that, and you can see that from their own reports. But that's exactly that. They have an entire stream of people whose goals are to bolster what they're doing, and by commenting. And so you'll like look at an app on like an Apple or Google Play, and it'll have ratings of 4.6, but then you read all the comments on it, it's not even in English because they just have people just blowing it up, So it's a widespread problem. It's bad.
Okay, and then what is this pig butchering?
Wait, before we get to pig butchering real quick, how much money has been swindled, stolen as a result of these scams?
So it's estimated it's like $75 billion.
Wow.
Billion over how long?
Since 21, so about a 4 or 5 year period.
So 4 or 5 years.
Yeah, it's a huge number. So pig butchering and romance scams are by and large the same thing because there's an aspect of either romance or just investment or vice versa involved in both of them. So romance scams, you still get the old school thing where you get like someone with a fake, match profile or whatever the case is, and they're, it's a good-looking dude or girl, interact, and it's all nonsense. Obviously, it's some poor, phishing page or whatever, but those aren't nearly as bad as the pig butchering ones. They're bad.
So what is the pig butchering?
It is that. So it's those text messages you get.
Okay.
And that build rapport. They move you over to WhatsApp. They continue building rapport, sending cool emojis. They wake you up. Hey, bro, how was your morning? Oh, I love you. Great night. All that kind of stuff. And then as soon as you get some investment advice from them, you start taking, their uncle always works for Goldman Sachs or one of these investment firms. And they get their heavy advice, So you just start throwing money in, and that's when you're seeing the returns, and you put more and more money in until we have people who've lost 6 million, 7 million.
Wow.
Yeah.
Whoa.
It's bad.
And it's interesting that the beautiful thing about digital assets is this 24/7 cross-border payment mechanisms, and then you can't get the money back when you send it as well.
Right.
Or if you get hacked or whatever, you can't get that back. And that's been something that's like it's a feature, not a bug. But in these instances, it is a bug.
Yeah. Well, honestly, these cases are easier than traditional white collar cases where it's just banks because, like you're saying, the blockchain is open. I can see where your money just went, right? So for us, it's actually easier because I don't have to interact with the courts as often to trace your assets. The problem is because it's so decentralized, the money can go across bridges and do all kinds of crazy things before you can even get to an exchange if the exchange is compliant with you. And then that also means that, whether or not you're talking to a law enforcement knows what they're doing because this is not like a widespread skill yet. You have some federal agencies that are all doing it, obviously, but the state and local law enforcement aren't at capacity to do this yet. Yeah. That's the problem.
We just had a conversation with someone who was kind of caught up in this. It was, there was a North Korean scam group, but they Circle froze this contract, and this DeFi protocol got caught up in this. But the reality is they didn't need to freeze it in order for Circle to fix the issue. The judge just was lacking education and sort of made the wrong order.
And I'm actually curious about that. There's this DPRK group that's been exploiting
Lazarus.
these DeFi protocols. This Lazarus group.
Yeah.
Have you done any work on with sleuths and things on DPRK and?
No, so at the state and local level, we may get an instance of some flavor of that, but a lot of times that gets pushed right to the FBI because it's such a diverse nation-state issue.
Yeah.
Is the FBI working on this actively?
Oh, yeah.
Okay.
For sure.
Is there anything that you can say about how much progress they've made to, identify these people and ultimately get them into custody?
I mean, it's tough, right? Because you're dealing with a lot of different protocols that they're involved in. They're mixing things, and there's a lot of stuff. But my guess is they know what they're doing. The problem is the jurisdictional capacity. Then you have obviously a lot of the conversation you have to have with these different countries that aren't really compliant with us.
Yeah. Yeah, because these exploits from the DPRK have been a large part of their GDP on a yearly basis.
But it's also the same thing for like Cambodia. So Cambodia estimated like 30% of their GDP is scam money.
Wow.
Because of the compounds that are running the pig butchering, investment scams, romance scams are all based out of those countries. And their GDP is primarily based on scam money now.
And their government is reinvesting into this business category because it's making them a significant amount of money.
Yeah. Yep, and the problem is corruption. Honestly, it's the broken heart of these people is that they can't get out of their own way because of the amount of money they're making.
Yeah. Okay, so let's talk about solutions. Like, what have you found has been some of the most effective strategies to prevent businesses, people from falling for these scams? And then, once they do fall for it, what is the recourse?
Yeah, I think education, obviously, unfortunately, is the number one topic, right? If you're not understanding crypto, I don't think you really need to understand how the blockchain works and all this kind of stuff. You need to understand what it is and who knows about it, right? You need to find someone who can educate you or be on your team that can educate you. So if something happens, then you can jump on it, right? I don't want to wait until it happens to figure it out. You don't want to call the FBI 2 days after it happened. You want to call someone immediately when it happens, right? So I think that's one of the biggest things is education. And then the second part of that is having a good contact at a local agency or state and local or federal agency that knows this stuff So if you are a business and you're compromised in some capacity, you have that contact immediately that it happens.
Yeah.
And public-private partnership is the biggest part of this. That's always like such like a catchphrase that people uses, but I think it's like a big part. I think a lot of our success in the beginning was that. So like when the crypto kiosks were Bitcoin ATMs were a problem, we regulated them. But when we regulated them, we had them in the room making the conversation and designing the regulations. So that built trust between the two of us. So if they had an issue, they came right to us now instead of us having a weird dynamic.
In the more digital assets, crypto specific world, what are the actual like industry fraud that you're seeing rampantly run? Is it like investment promotions and scams? Is it these exploits? Like what are the most common fraud instances that you've identified within the state and actually had a successful case against and prosecuted people for?
Prosecution almost never happens with these cases, and I think you kind of allege to it a little bit. It's you're trying to get this complex issue across judges and prosecutors' offices that aren't there yet either. So again, back to the education aspect of this, right? But I think what we're seeing a lot of now is smart contract exploits. Unfortunately, it's almost always scams. But then you also have rug pulls are huge. I've had a bunch of people who are following like the Twitter bro that has really good investment advice. They put some money in, right? And then they get rug pulled on a meme token, right? On Solana or whatever. So I think that those are unfortunately still happening. Yeah. And you may lose $100K on it, which is not like a big picture money. But if you have 6-7 people doing it, it becomes a problem, right? Yeah. So
are you guys working with any private companies like Chainalysis that can help automate and detect some of these unusual flows?
Yeah, absolutely. So, I mean, you can't do this work without having blockchain intelligence, unfortunately. Like, I can open trace this thing all day, and you wouldn't have the insights that those tools provided, right? So with Chainalysis, TRM, right, Heights Labs, we're involved with a lot of the companies because we need that insight. And we have, like you said before, the public-private partnerships. So, Anchorage Digital and some other companies that we're friends with that can help open those doors and have conversations with them. So it's super important.
Yeah. And so from your perspective on the public side, you work with a lot of these private companies and we talk when we think security of these protocols, oftentimes it starts with the audit companies. That's kind of our, portal into this world. As you're thinking about the private companies that are doing some of the best work and investors are thinking about, putting their capital behind stopping some of this crime. It's a big industry, 75 billion. We had, someone on earlier today talking about, how they're chipping away at the tokenization industry. Yeah. They're getting payday loans. It was 10 billion. It's felt like a massive, potential opportunity. This is 75 billion of added value that we can add back into this industry. What do you recommend to investors, venture capitalists? Where should they be allocating resources to ultimately help, establish more private companies and prevent some of this crime?
Yeah, I mean, the CISOs are like a super important part of this product. But I think beyond that, not the law enforcement's capacity or whatever or capabilities. I think you need to have someone in-house that just does that. Okay. That's a relationship builder, right? So not like a BDR or something like that potentially, but they're more so focused on establishing a relationship with the protocols and with the foundations and keeping those communication lines open from the enforcement side of the house. So if something does happen, you have a direct line of communication. So I feel like a lot of times, if I wanted to talk to someone with Ethereum Foundation, I'm not going to talk to a cop because it's weird probably or whatever, right? I think having those open doors is what's going to help because I'm not I'm good at what I do, but these guys who are writing the protocols and designing these platforms, they're the experts. And I don't have that. I'm not a math teacher. I can't, whatever. We need those people to kind of help.
Are you guys using AI and have you gotten someone on your team up to the level where they're able to? It's not intuitive for law enforcement agencies to be hiring software engineers and developers, but that's where we've gotten to.
Yeah, I love that you said that because literally when we talk our session at 4:00, you're kind of hitting on exactly what I was going to reference. That it's so funny because if you look at law enforcement's capacity to move with technology, it's slow as hell, right? I forget the averages, but I think to outfit an entire agency, get everyone trained, and have all the recurring education and software available to it, it's 10 to 14 years, some crazy number like that. Wow. So you have a technology like AI and crypto or blockchain that's moving as fast as it is, that time frame is not going to work. So we're not doing enough with it, and unfortunately, I'm not a decision maker in that space. So you need to kind of find a way to get that conversation happening, and the only way I can think to bridge that gap is explaining the level of fraud and how fast things are moving. Yeah, we're definitely not using enough though, for sure. Yeah.
Last thing from us, I think, Detective Hogan, is what is your the rest of your year look like? Like, is there cases that you're actively working on? Are there new like areas that you're trying to get more involved in? What does your kind of next 6 to 7 months look like?
I look like I'm crushed. We're crushed, dude. We just get so many cases, and because of that lack of capacity, we're helping local agencies out because they don't have that capacity, and we're also helping the feds out too because not every state, like Connecticut's small, so like the field offices may not have capacity either. So we'll get cases sometimes from them too. So like we just get smashed. So I'm actually, like I say this all the time, but I'm terrified of like agentic commerce. That like terrifies the hell out of me because if you can imagine yourself in your own foot, you own a business that has like agentic agents going out and purchasing or doing things for your business with a credit card or whatever they're using to do that. Now you walk into a barracks or a local police station and you go, hey, officer, I want to report a larceny. And like, okay, what happened? Well, an agent that I was using transacted using my card on this website to develop the blah, blah, blah. And the cops can be like, what the hell are you talking about? Yeah. And they'll tell you, oh, go to INC3.gov and file a report, and that's what's going to happen. So like that kind of stuff is what we need to be preparing for. And because by the time we prepare for it, something else way worse is going to be here. And that's why I'm preparing for that.
Yeah, I mean, and then who do you blame? The agent, the merchant, the person who developed the agent, the person who prompt injected it. Like who, you know what I mean?
Well, that's like the tornado cash issue, right? Like they're trying to how do you arrest someone who designed a protocol that functions by itself,
exactly.
right? Like I like crypto, honestly, as from my perspective, I think it's really cool. I like the way it works. The use case for it is there. So I don't think arresting someone who wrote a protocol with the intent for good, obviously, the intent's a big part of it. But you can't go out and do that kind of stuff because then it ruins innovation, right? It slows that process down. I think having that conversation, leaving that door open, is how you fix the problem.
Yeah.
Mr.
Hogan,
these are important conversations.
Pleasure, man.
Cheers,
Yeah,
man.
thanks for nice to meet you guys.
Yeah, appreciate you coming.
Guys, that is our local in-house detective here at the Roll-Up for Digital Form Fest, Future Connecticut,
Fest.
Stanford.
Yeah.
We're staying away from law enforcement here on this show. Guys, we're going to take a real quick break and we'll be right back with our next guest.
Money, power, I'm big, 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 but I'm big, I'm right big, 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 but I'm big, money, power, I'm big, 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 but I'm big. We get deep, you know we get deep. You know we get deep, we get deep. You know we get deep. We get deep. We get deep. We get deep. You know we get deep. We get deep. We get deep. We get deep. Hot. You know we get deep.
money, power, and money, power, and
we get deep, you know we get deep, you know we get deep, we get deep, you know we get deep, we get deep, we get deep, we get deep, you know we get deep. We get deep. We get deep. We get deep. Hot. You know we get deep.
Money, power, I'm big, 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 but I'm big. I'm right big, 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 but I'm big. Money, power, I'm big, 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 but I'm big.
We get deep. You know we get deep. You know we get deep. Hot. We get deep. You know we get deep. We get deep. We get deep. We get deep. Hot. You know we get deep.
back to AI Supercycle, our premier AI show, airing every single week, presented by Near. We cover the ins and outs of decentralized AI, privacy, and the future of this massive technology.
Near is the blockchain for AI and the execution of AI native apps. You can check out Near's latest AI product at near.ai. Now sit back, relax, and enjoy the show.
Welcome back to the CT Digital Forum Future Fest in Stamford, Connecticut.
Been working on that one all day. It's
UCONN.
CT Digital Forum Future Fest.
Here in Connecticut, we are talking with Sal Ternullo, the man behind Sovereign, the DAT for Near, the development company, a friend of the show, and a lovely, lovely man in a nice sport coat. Sal, great to have you.
Thanks, man. Appreciate the warm intro.
Yes, sir.
We've been talking about
what a couple weeks for Near.
Yeah.
Right? I mean, probably surpassed a lot of our expectations. Take us back a couple weeks back. We got this kind of trifecta. We got Arthur Hayes talking about it. Obviously, this kind of like AI agents using intents, using Near intents confidentially. The TVL has been rising. People are kind of getting it. Take us back last couple weeks. What's been going on your side, in your mind? How have you been processing what the market's reaction has been?
Yeah, I mean, this is, I think if you guys remember the first time we chatted, probably 4 or 5 months ago now, we kept talking about this market mispricing. Like, this is the perfect cohesive technology platform, vertically integrated products with value accrual mechanics to Near. And I think the market is now finally understanding how to underwrite Near as an asset, which is not as a comparable L1 basis. You have to really think about revenue generation and market opportunity around intents and Near AI as well. And I think there's also, even as recently as this morning, Arthur from Defiance was making a point, like intents TAM is not crypto to crypto swaps. Intents TAM is the commercial architecture of intents being expressed in the real economy. So that might be the example Ilya always gives of like, I want to deliver steel to this factory for this build. It's the architecture of a commercial deal where payments are a layer of settlement. And we're just really kind of scratching the surface in terms of the initial opportunities and use cases around it. So repricing in the asset, obviously we've seen a lot of uptake in terms of Arthur and many other KOLs picking up on it. We've also seen massive inbound from institutional investors in the liquid fund category.
More on the AI side, on the revenue story side, like what's the exciting part for them?
Mostly digital asset funds, to be clear. Like they're underwriting the AI opportunity, the privacy narrative, and seeing Near uniquely positioned in that context. But the amount of inbound, like next week we have our Backer Summit. It's going to be the most widely attended Backer Summit. Like hundreds of funds will be there. And there's a lot of folks that are taking positions. So I think we're just stabilizing here, a little bit of chop sideways through the summer, and we're going to be up for the end of the year.
Despite Bitcoin's struggles.
I mean, this is one of the, on a statistical basis, Near and Bitcoin over the last 30 days have had a negative correlation.
Right.
It's crazy. I mean, I've been doing this for a long time. I've never seen alts have negative correlations to Bitcoin, like Hype, Zcash, Near, a select few others with real fundamentals. And what's interesting is like, it's all fundamentals driven that's driving this negative correlation.
Yeah.
Obviously, with the sell-off with the stretch news yesterday, and then Arthur talking about the dump in context of macro and midterms, everything started to re-correlate on the way down. But I've never seen relationships between Near or other assets in the alt space to Bitcoin like what we've seen.
How
in the past
long
few
do you
weeks.
think it lasts? This discorrelation, because it's not just uncorrelated. At least for a little while, it felt like they were actually divergent.
Yeah, they were negative correlation.
Negatively correlated.
Near was performing, moving up 170% in 90 days, and Bitcoin was flattened down through that period. I haven't looked at the charts to say this is unprecedented. There's not been another example of this, but from an anecdotal experience perspective, I've not seen it.
So the question was like, how sustainable? Like, how long do you think this lasts?
Oh, that's a good question. I was actually just talking with one of our team members, Frank Camato, about this. Like, do we expect this negative correlation to persist? And I think people are going to be taken by surprise with Clarity Act. I'm in the camp of, I was just saying on stage that I think it's an 80+% probability, despite the heat that we're getting from Jamie Dimon and many others being vocally against it. And I think that the industry just underappreciates how important rules are to institutional capital allocators coming in. So I see that as a major bullish catalyst. I do think the summer is sideways, but I think the end of the year, despite the midterms, is a really good setup. The biggest factor here is how long do how long does Iran last? How long do oil prices stay high? And what's the trickle down effect in inflation data that the Fed's going to read on, the dot plot on a forward outlook? So, I don't expect this negative correlation to continue forever.
Okay.
On the near specific side, has your kind of investment thesis, as you've been, talking to funds about it, to allocators about it, to investors, KWALs, whomever, has it changed materially over the past couple months? Obviously, confidential intents have had a huge growth. The AI kind of boom of Venice as a protocol and as a company has done well, and Near is powering some of the private inference there. Like, what has been the changing in the pitch for Near, the asset, in the last couple months?
No, I think you honestly nailed them, man. Like, you guys are pretty close to the ecosystem. Privacy as a narrative has continued to run hot. Started last September. It's continuing through today. I just got a question from Jamie Coots yesterday in terms of like, where does Near sit relative to Zcash? Is it competitive? And my view is absolutely not. We're providing a privacy computation layer on top of a private sovereign asset. And that's a constructive and complementary thing.
Just real quick, I like to think of Near as the Ethereum to Zcash's Bitcoin, if you will.
Yeah, it's very similar kind of. They're complementary. They're not competitive. But privacy narrative running hot. The Near AI product side is actually starting to get to a place now where like Ironclaw user experience is much, much better. You're going to see some real use cases coming out around that. And then the part that gets me the most excited is the mechanic design behind private inference and Ironclaw. And I think towards September, October, we'll be in a position where, Near Foundation will be in a position where they can start to put forward views on how these mechanics around the AI product stack accrue value to Near, the same way that we see with intense buybacks today.
Yeah, so we've been speaking about this relative strength, of these three categories. It's been revenue, leading Hyperliquid has kind of been leading that charge.
Yep.
Privacy from, Zcash has been leading that, and AI, Near VVV with Venice, have been leading this. Now WorldCoin is doing this as well. They've been the most strong relative to the rest of the market. In fact, negatively correlated, as you pointed out. And I think we anticipate that these will continue to outperform once the market turns, but they will hold up better than the rest of the market because they are the ones that are garnering the most attention. Near feels like it's hitting on all three. I know I put it in the AI bucket, because Hyperliquid and Zcash are kind of even more pure representations of the other two, but in reality, Near Intense, confidential Near Intense is the best example of all three. Yeah. It's surging on the revenue front. TVL is up and to the right. It's confidential, and so it has privacy enabled, and it is enabling AI on multiple levels, Near as a whole. And so how do you think about these three? Do you think Near is the best expression of the three as they converge? And yeah, I guess same question, but just with this context in mind, how do you see these categories progressing, and generally, how do you see Near progressing as a leader in these three categories?
Yeah, I mean, you guys are nailing it today. Very well done. It is like the spot on expression of all three, and it's the most mispriced underlying asset. What's hyped today? 17 billion fully diluted. Revenue model through the roof on a comparative basis to Near, not contesting that in any way, shape, or form. But when you look at the only project that's hitting on all three of these kind of critical primitives that are narrative driven today, Near is really the only one playing in that group. Even if you look outside the Near ecosystem and look at BitTensor, a lot of really exciting academic and computer science work on decentralized training, decentralized compute, inference, not in the same position for a run the way that Near is. So super bullish, man. I think the whole ecosystem and a lot of the investors feel like, to some extent, validated that the market is now waking up to recognitions that people that have been investing in this ecosystem have had for a while. But really the work's just beginning. We're in the meat of the product execution sprint now.
Yeah. Sal, you're an investor, right? You're in a company that is meant to acquire Near, hold Near, be a long-term investor. Every great investor understands their upsides and their downsides. They understand the risks associated with a given asset. It wouldn't be fair if I didn't ask, what are the tail risks for Near here? What are the things that, from new investors who are listening, watching, what is there to be aware of that need to be understood for, what the kind of more bear case is here?
Yeah, I mean, the space where there is by far the thickest competition with the greatest capital depth is in the secure harness category. And like what Ironclaw has done, in my opinion, from a security architecture point of view, has some real competitive advantages versus everything else you see in the market. But we're taking crypto as a 1.75 trillion, 2 trillion, whatever the total market cap of the asset class is, and talking about competition and AI product that is comparable to companies that are raising 100 billion, right? And so to think there won't be competition and it won't be fierce on the AI product stack would be naive. I think the magic of this is the intersection of these components, allowing for Intents to be this ubiquitous liquidity and transaction layer alongside privacy preservation, alongside sovereign control, and introducing the secure harness that Ironclaw offers. But yeah, I think that side of the market's going to be very competitive, and there will be new entrants as well.
I saw a flowchart sort of design architecture diagram from the Near protocol account recently that described how Near underpins Venice and how it helps to secure these things. And I think you're right. I think the convergence of these three categories is the real value proposition and potential ceiling here. Can you describe a little bit more how Near helps to support some of the initiatives like Venice with their private models, and then there's other things like I think maybe Near and Hyperliquid could potentially collab, or Near and Zcash. We're seeing more collabs, but with respect to Venice, this one is already kind of it's already happening. Can you just describe it a little bit in more detail?
Yeah, like the way that Venice is set up, and I think Eric just gave this really good descriptor of like where it sits in the kind of like almost like a middleware, but with a consumer front end that allows consumers to select different trust assumptions and different trust models of how they interact and different levels of privacy as a part of that. Near's infrastructure on the private inference side is one of those underlying providers, which provides the greatest degree of trust in cryptographic verification around users' interactions through inference processes and confirmation over what models they're actually touching that are running inside of TEEs. So I think you're going to see a lot more of that, where there's B2B integration and support of Near private inference for those attributes. But Venice has been doing an incredible job. Like, it's all over the place right now. So hats off to Eric and the team.
Yeah, Alibaba just posted about their models. And yeah, it was pretty insane. One of the things that we've been asking a lot of these different kind of like L1s and chains is about the token value accrual, and like a lot of what we've been seeing is this institutional adoption at scale and a kind of like a lack of a re-rating of the actual asset underneath due to kind of broken token models. And we got some flack from that from a couple of different teams for asking them this. And same thing, to Near, the goal is to get deflationary, right? At the underlying, you want to be generating more revenue, having enough buybacks and buy pressure on this asset to offset any future issuance, which inflation is getting cut down, and just general expenses. What is the realistic path to Near becoming more deflationary? Is there an inflation reduction in the future coming? Ilias says next year at some point potentially. What is the confluence of factors that needs to happen for us to be able to look at this asset and be like, guys, it is a no-brainer because it is objectively a net positive?
Yeah, it's a really good question. And before I go into the actual technical answer, to be direct with you, like I think the jury's out in terms of what is the optimal economic design within a system. Like Hyperliquid almost faces the opposite challenge, which is like at $500 million a year run rate revenue, buying back tokens, like is the 99% buyback actually the right structure for them, or should they actually be generating revenue to drive further product development and expansion in other categories over time? And like TBD, we don't know. But for Near in particular, over the next 12 months, the number one metric to look at in terms of actual buybacks and value capture in the token is going to be Intents volume scaling. We've been looking at Intents on an average basis, 50 to 70 million daily through pretty bearish market over the last 6 to 9 months. The research report we put out in March looked at 170 million with a blended take rate less than 10 bips on transactions being the inflection point to deflationary. I think we'll have a more objective point of view coming out from Jamie Coots and Real Vision over the next couple of weeks in a report that they're painting. And then I think the whole AI stack and the mechanic design around that will accelerate. And so we'll put out another research report September, October that doesn't just address the fundamental bottoms-up underwriting case for Intents, but actually contemplates both of these vertical product stacks coming together with united mechanics. And then to Ilya's point, we will continually evaluate as an ecosystem the inflation mechanics around the system to optimize the design there. He has a better line of sight in terms of timing and thinking there, but obviously we're supportive of the scenario that drives the best value accrual and market expression in Near's Near's token price.
Sal, do you think Near is charging a fair fee for Near Intense? Because I'm looking at the Dune dashboard here, which has a ton of great stats. $20 billion of all-time volume through Near Intense, almost over 2 billion in the last 30 days. Only 35 million in generated fees. It feels like that number should be higher. I don't know. That feels really, really affordable, cheap, if you will, like in terms of like the costs that Near is charging for fees through this platform. Do you anticipate that Near will increase fee? And this actually plays into the conversation we've been having with several token protocol L1s. Like I'll just reiterate quickly, we had this exact same thing. We asked John from Avalanche and Avalabs earlier today. We asked Donnell from Stellar. We asked Joe Shalom as it pertains to Ethereum. All of these blockchains are trying to scale. They're bringing their average transaction fee down, but their business model, their token value heuristic is built on fees flowing to the token. These feel totally disconnected. They feel totally contradictory to one another. So obviously Near can drive even more volume by bringing fees down, but they're a business. They're meant to drive revenue. So where does that barometer end up? What is equilibrium? Is this currently a fair, fee model, or generally what should change up, down, sideways?
I think as compared to pretty much every one of these other L1s that you were describing, Near stands apart and is unique in that it has this vertical product integration and is monetizing Intense in addition to the protocol burn transaction fee, which, to your point, block space is commoditized. It's super cheap to transact. It's only going to get cheaper over time. Where Near's strategy is different from all of those others is that effectively the Uniswap protocol is accruing value to Near. So in the Ethereum context, I explained this on Bankless maybe like 2 weeks ago or something. This was the example I gave, was in your world, David, Uniswap is accruing value to ETH. That is the case in Near. So in terms of actually pricing power and fee structure, I think you've probably seen the last 3 weeks, Confidential Intense has just literally ripped in terms of volume and TVL. I think there is a premium to be paid for private transactions in the world. And so I think you may see more pricing power for Confidential Intense as compared to the pricing structure that existed for vanilla Intense. And the team, if you look not only at the Dune dashboard, but at the actual kind of profit that the protocol is making over time, that is not reflective of the fact that the fee switch was flipped in February, and then there were bilateral distribution agreements that were inked over the next 90 days. And so pretty much 95% of the volume that's processed through Intense has those in place now. But the bottom line profit to the protocol is not reflective of that fee switch, and 100% of everyone using Intense was actually fee sharing at that time. So I think the next 90 days will be the first time where you can actually look not just at top end fees, but also at the bottom end profit to the protocol for net buybacks. And I think that's an important metric that people in the market are looking at and trying to really understand, like, okay, to your point, 35 million fees, is that a fair take rate? Okay, what's the actual protocol take rate behind that? Why is there a variance between what we're seeing? And this is the logic and kind of path it took to get there.
Yeah, and I think Ilya tweeted about he wanted to see a future where it's not just a button on the dashboard on near.com for confidential or not. It's just always by default. And so that could be a way to add that take rate to all the transactions, a little bit of a premium on it.
Yep, absolutely.
There was a dashboard that was launched by the Aerodrome Foundation recently, or it was Dromos, it was associated with Aerodrome, and it was illustrating this net token value flow across several protocols. And as I understand it, it is essentially saying there's income into the token, there's earnings, there's revenue, there's buybacks, this all value flows into the token. And then there's emissions, there's expenses, there's things that flow out of the token. Very simple. If you have more coming in than you have going out, then you're gonna be in that green category, you're gonna be looking good. Hyperliquid is at the top of this, but there's others on there like Cake, right? Cake Swap from Binance Chain, there's Pump Fun is on there, Aerodrome's own token is on there. But all, Hype is clearly, different amongst that category. Not all of those, even though they all have more coming in, there's variance in how their tokens are performing. My question is I guess generally why, and I thought about this a little bit, and the answer I came to is that Hyperliquid is programmatically buying back their token. There is a pre-commitment that says 99% of the revenue here, and we can forecast and project how much revenue is probably coming in, is all going into the token. Whereas Pump Fund seems to kind of do these buybacks like once in a while when they feel like it. I'm not sure, Cake, Arrow, exactly how their models work. But as we're thinking about this and then looking at Near in particular, how important is this pre-commitment for buying back the token and value flowing into it?
Yeah, it's a really good question. It's a space where, to your point, like the approaches in the market are pretty wide right now. Like you have the Pump Fund, fully programmatic, fully transparent on chain as a result of a validator vote, despite at the time being pretty tightly controlled on the decision, all the way down to completely intermittent, random decisions to buy back in bulk at time to support price for some protocols. That's not the case in Near. This is a space I think you will probably see standards start to emerge over time in terms of how value accrual actually flows back to tokens and what is the reporting and transparency expectations around that. And I know that from the Sovereign perspective, we're committed to driving the ecosystem in a direction that very much meets the edge of the market to give investors confidence and certainty in underwriting the asset. We don't make those decisions, but our view is whatever creates the most certain foundation to underwrite the asset with the best data and information available is net positive to everyone, because we think that data and information leads to a really compelling investment case, hence why I'm doing this job.
Yeah.
Sal, man, thanks for spending some time with us.
Always fun, guys.
Absolutely love to see the growth over the last couple of weeks. And I think, there are some levels to take out, but it's the fundamentals that are driving this, and that's what matters. I think that the market's very much responding to the fundamental growth of certain crypto assets, blockchains, et cetera, and that's what we want to continue to kind of foster on our show and just broadly as an industry.
Love it, guys. Appreciate it.
Yeah,
So,
as always. Thanks, Sal.
Appreciate it, man. Good to see you as always.
Oh, yeah.
Oh,
Come
one
on,
more.
the baller boy.
Linking.
Oh, I think you put on timer.
Oh.
Is that what that is?
Give it up for Atan in the chat, guys.
There we go, Atan.
There we go. Guys,
Love
we're
it.
going to take a super quick break. We have our next guest here. We'll be right back.
Nice.
That was AI Super Cycle
You're good.
episode number 36.
Thanks, man.
Next time, Ness.
We get deep. You know we get deep.
Alrighty, guys, welcome back to the CT Digital Forum Future Fest in Stamford at the University of Connecticut campus. We are joined today by Diana Barrero, a big blockchain enthusiast here at the conference, one of the few, blockchain believers in the era of Bitcoin testing its lows. We're zooming out here, Rob. We're taking a step back, and we're being bulls.
And he's been watching, these 5-minute charts on TradingView. So we're taking a bit of a longer time horizon these days, looking a little bit more at the fundamentals, which
better.
Yeah. So, I think this is right up your alley. You're head of GSMI and research at the Global Blockchain Business Council. I also noticed, I think there's a Yale association, if I'm not mistaken. So would love to understand a bit more about your background and your current focus.
Absolutely. So I run our Global Standards Mapping Initiative, which is the GSMI, and research at one of the industry associations called Global Blockchain Business Council, GBBC, another acronym. But we're the largest leading industry association in the space, advocating for innovation in responsible ways and blockchain technology across all sectors, from like nonprofits to large corporates, financial institutions, academia, and we bring them all together to talk about the most pressing themes in blockchain technology. I'm also happy to be here at the Connecticut Digital Forum, the association with Yale. I've been putting together a number of convenings with alumni, especially from the MBA program, to again, convene the industry, especially along financial services, to connect and talk about the space, right? So it's an exciting time right now, I think, because we're finally getting regulatory clarity in many ways, and we're also seeing institutions taking this technology for real in ways that we never would have heard of before. Like the level of partnerships between DeFi and traditional finance institutions. I can get into more detail, but it's a really interesting time right now if you take that long-term horizon.
Absolutely, which we've been focusing more on. Given the GBBC is this industry association, is it mostly focused on policy or kind of bringing people together? Like, is it a nonprofit? Maybe you could just unpack a little bit more about how it works.
Nonprofit. We have over 500 members across all walks of life looking into blockchain and digital assets, from builders to regulators to standard setters. One of our focus areas also is standards, which is something that I'm very, very involved in. And we're happy to say that we got approved as a Category A liaison as part of ISO, the International Organization for Standards, which sets the common rules of the game. And I mean, there's many players, but it's really, really important right now to have common rules of the game so that we can better scale, ensure better interoperability, growth, so that everyone can agree. For example, if we're tokenizing, right? If I tokenize on my platform and you tokenize on your platform, we're not going to be able to trade together across platforms and really reach that global interoperable marketplace unless we have common rules of the game. So it's that kind of conversations. And obviously policy is a big part of it, and also risk mitigation frameworks.
One of the things we covered earlier this week on the show was Olivia's Van Wood, who worked at the Avalanche L1, and she was talking about the national best bid and offer, which is this regulation that says, when it comes to equities, If you trade on one of these 16 regulated exchanges, you are legally required to get the best possible price, of any of those exchanges. And in that sense, those exchanges are very interoperable and composable with one another because they all legally are required to give you the best bid. And she was arguing that this should extend to tokenized equities.
Of course.
And that we are currently missing the NBBO on chain, but an equity is an equity, whether it's tokenized or not. And so that rule should apply. Is this an example of some of the things that you're advocating for? And generally, like, are they, maybe you could just provide some more concrete examples.
Yeah, conceptually, across the board, anything that has to do with common rules of the game and standards. One thing that is really important when we're setting standards, it's also the process in which a standard is developed and the stakeholders that are involved in basically giving an okay for those common rules of the game. I can set my standard right now, right? And we don't want to have like a redundancy of yet again more rules of the game because there's so many, and we want is harmonization.
That's the meme. Is like, okay, we've got these standards, and everyone's trying to come up with the next standard or come up with the same standard. So it's like, we need another standard, right? So that that's. And so like, how do you avoid this? And generally, what are you working towards?
I mean, a lot of it is convening and getting the right people in the room and getting the right process. Like an organization, I mean, the landscape of standards as part of the Global Standards Mapping Initiative, I've worked with many of our stakeholders to map out over 100 standard setting bodies all over the world that are doing different things towards standard setting, whether it's actually setting a standard or providing the inputs to a standard or doing joint working groups or providing common rules that are ad hoc approved by the industry, or there's more formalized, globally recognized standard setters like IEEE or ISO that are kind of like the gold standard, but they're very, very bureaucratic and it takes long to both comply with them, and it takes forever also to both create those standards, right? So in that vacuum, sometimes organizations end up creating their own ad hoc industry-based rules of the game. So we're trying to harmonize, putting it all together, and everybody knows it's important. It just takes time. It's a process.
Yeah. I mean, we have like the regulatory side with like laws and bills, and then there's standards like on chain for different like token types and different types of assets. And then there's like bringing these two worlds together. How much difficulty has there been by trying to kind of convene people to understand and to educate them on kind of what's happening in this world, and then bring that to like a consensus outside the world, especially when you're dealing with traditional financial firms? Maybe like what standards do they care about? What core consensuses are you trying to achieve with them? So I imagine it's not all the nitty-gritty that people inside the industry really care about. What are the core principles of what the institutional allocators and firms care about?
Yeah, I think standards that are trustworthy and standards that are comprehensive. Another issue that we face in the industry is the convergence between like open source. Some standards are open source, some standards you need to pay for. So the accessibility of standards. And also sometimes the industry just happens to revolve toward one direction as opposed to like the socialization. There's like a network effect overall. And you bring a good point as well, because there's also technical standards, but there's also like regulation, right? And often we see that industry standards may precede and even provide inputs to regulatory developments. So I think mostly it's getting the right people in the room and getting the right people to agree on the same rules. But again, it's a set of conversations. You have to be very targeted. You have to be very intentional, because it's a very complex space with a lot of different players doing a lot of different initiatives, whether it's frameworks here, and sometimes they don't even know that they're working on their internal standards because they don't talk to each other. So there's redundant work going on where those silos should be better broken.
What are the some of the frameworks and standards that the Global Blockchain Business Council has implemented up to now?
Well, we're not essentially a standard setter.
Okay.
We advocate for better standards in general. So part of that is our involvement with ISO, where we're bringing experts into the ISO TC307, which is the Technical Committee on Blockchain and Distributed Ledgers, to bring the right expertise in place into the right working groups to talk about digital identity, taxonomy. Often it starts with taxonomy. What are these things? How do you even define a digital asset? If you're not on the same page, like everything can lead to discrepancies, right? And then also regulation, a lot of engagement with regulation. And then we also have a token taxonomy framework as well, which is an open source standard that has been developed through one of our branches under the Inner Work Alliance, which is a standard to tokenize anything. And it's been highly adopted in the world of carbon markets, where, again, standardization leads to trust, leads to more accountability, especially in a market where there's been significant costs due to lack of trust.
Wow, very, very cool. And, we've had conversations with like the Digital Chamber of Commerce, which is this lobbyist group, and they do a lot of work in DC, and they have some of these member companies that help lobby for, in some cases, the Genius Act or the Clarity Act. And people don't always agree. Famously, Brian Armstrong was sort of anti-Clarity in one form because there was a discrepancy around yield. And he was kind of pushing back on the crypto industry. And so given that, you've got a very general set of...
we're very neutral as an association. We don't take sides. We talk to all sides of the picture, and we advocate for responsible innovation, but with a very very neutral approach.
Yeah.
So we don't do lobbying and
And a lot of the work that we do and we see is, people come on the show and then we see them on Twitter and in these conversations, they don't agree on definitions. They don't, a lot of times people are very technical, very passionate about these things. And so how do you ultimately come to a common understanding of the space when things are so technical, so complex?
We've actually had a working group going on for a number of different years on just focusing on taxonomy, where step one has been focused on what are the key terms in the space and what is the landscape of definitions. So instead of developing yet another definition, just landscaping, what are the globally recognized definitions from what sources? What are the globally reputable sources, including standard setters, including different regulators, including reputable industry glossaries, and different associations. And we see a lot of discrepancies still.
I bet.
Yeah.
I bet. Yeah. Last thing from me on the kind of like general work that you're doing here, is there any specific sector or part of the industry that is demanding the most amount of your attention right now and time? Is there a specific, this kind of traditional finance and DeFi convergence is obviously happening.
Yeah.
Obviously this opens up a whole, breadth of new situations. What part of this industry is demanding the most amount of your attention?
For me right now, as you can see, I run a lot of working groups on key themes in the space, and I'm seeing more and more the interest in institutionalization. So it's really bringing blockchain and digital assets and innovation and translating them within frameworks that can be acceptable and considered as legitimate by financial institutions, corporates, and large-scale players, including regulators, because that is what's going to pave the path towards scalability, right?
Yeah.
Got it.
Last thing for me is, similar to how the Digital Chamber is sort of this liaison between blockchain companies and policymakers in DC. It sounds as if the blockchain business
putting
council
the
is sort
right
of
people into the room.
Yeah, like this
address
liaison
topic.
between digital asset companies and the standard setters.
Yeah.
Right. And so my question is, what is ISO looking for? Right. And from these companies, generally before something gets put into one of their
They have a very structured approach toward developing standards. That, again, I said it takes a long time. It goes through many reviews and iterations. Once the standard is published, it's the gold standard. It's very reputable, respectable, and everybody wants to adhere to it. But the process to get there requires, and they're very grateful for inputs like ours from experts, whether it's in the form of reports that we've produced or industry recommendations, or right now we're focusing a lot on use cases, blockchain, digital asset use cases, where it gets real, where it gets tangible. And we've documented 101 use cases across different industries into a use case handbook, a volume. we're about to release version 2 this year.
Oh, very cool.
So just where it gets real and what are the processes that are involved.
And where can our audience find that handbook?
It's in the GBBC.io website. We have version 1 out right now, but then again, very soon, in a couple of weeks, we're gonna have version 2.
Beautiful.
Beautiful. Diana, thank you for spending some time with us. Hope you
Yeah,
had a great
really
rest of
appreciate
your
it.
conference. It's been a beautiful event. There's a lot of different sectors here. Keep pushing this industry forward, right? Doing the Lord's work.
Yeah, thank you so much.
Thank you so much.
Thanks,
I'll
Diana.
see you next time.
Thank you.
Yeah, absolutely. I think we're gonna
Take a little
we're
Polaroid.
gonna get our picture taken here.
See if you can get it.
Let's see if we
See
got
get
it
the
this
right
time.
this time.
Bang! Let's go. What's
Get it.
on?
Thanks, Diana.
Thank you so much.
Wow, I can't even
right.
see right now. Whoa. Damn.
Flashbang.
That stuff's strong, man. What was that? That must have been some of that new stuff.
Why don't we
talking smack, I had to up the game.
Yeah.
Whoa.
Oh, it hit. I had a delayed effect.
go,
I
Knicks.
just got it. Whoa.
Whoa.
All right.
What's going on out there, guys?
Let's see.
Chat, how we doing?
I'll tell you what. Right now, Canton has been a stable coin at 15 cents.
Yeah.
Whoa, WorldCoin down 10% in the last hour.
Yeah, classic.
We're back to the 5-minute candles.
People are mad at Hayes right now, man. I'll tell you that.
Oh,
They are mad
boy.
at Hayes.
Oh, boy.
They do not like
All
Arthur
right.
right now. Thanks, Diana.
Thank you so
Cheers.
much. We'll see you next time.
Wow.
Look at that.
Man, Purse fighting for his life here. Well, what do we think about Shamus buying at 65? Upping that cost average, you know?
There he
Jarvis.
is.
Is he next? He doesn't know when he's coming on. He's lost.
The schedule got changed. It's David Hendrickson.
Hey, David.
Hey.
How are you? I maybe.
I think it's like 220 or
Yeah, I think
Yeah, we got you at 2:30ish. But if you,
2:30, that's
yeah,
we've got Jeffrey
All right.
Wallace coming up next, and we'll talk then.
What would you like to
Yes.
talk about or not talk about? Or
I've not.
I think we had here
I did the
Okay.
governance panel. I moderated that.
a lot of this kind of AI in companies conversation.
All right, beautiful. Let's do it.
Disruption of labor force, boards, governance, all of that conversation.
Good.
I think you're an expert.
Can I bring some notes?
Please do.
Yeah.
Okay.
Alrighty, sir.
We'll see you
Looking
then.
forward to it. Digging the. Yeah, man. Alrighty, guys. Clearly, there's a lot happening here.
Yeah,
in
we're
Connecticut.
in the middle of it right here. We're in the
Wow.
thick of it. We've got
Wow.
we've got banks, past, present, future.
May I get you guys anything? Drink, water?
No,
coffee?
sir.
We're
I think
great.
We're sorted.
Yeah.
Thank you, David.
Yeah, appreciate it.
Ayab Khan, what's going on, man? Still here, still vibing. got another hour and a bit left. Straight back to New York.
Incredible last 30 minutes. I think we've got
Straight
our
on a Thursday.
next guest coming in.
Yes, sir.
Come on over.
Jeffrey.
We're ready for you.
Yes, sir. How are you doing, man?
Excellent. Great to see you
Great
guys.
to meet
Great
you.
to see
Andy.
you.
Pleasure to meet you.
Robbie, good to meet you.
Jeffrey Wallis is the CEO at N3XT. We just had your colleague on the
Yes.
show, Scott, one of Robbie's friends from, I don't know, from Gainesville, or how you met Scott.
I didn't know. I met someone at N3XT at our Modern Money event series that we do in New York.
Right.
And he connected us with Scott, and ultimately got us a little bit further along when it comes to N3XT.
Yeah.
Told us a little bit about the origin history,
Yeah.
of which there is quite a bit to dig into, and I think Andy did with Scott.
Indeed, I did. It was
And-
good.
Yeah, yeah. And so Jeffrey, now you're here with us today, and I think Jarvis came in. He said, "Okay, well, let's get Jeffrey going on the on the future of the banking industry."
Yeah.
And he said that you've got a lot to say on this topic.
Well, I've got a lot of scars from it. How about that? And so, yeah, it
So
gives
were
me a lot
you-
of things to say.
You
Yeah.
were with Scott at Signet and all of that, or?
Yes. So at Signature, I ran the digital asset product and strategy. And so we built out the Signet platform, created that ecosystem, built out the community of essentially traders and then logistics firms and payroll firms that really wanted to have their fiat dollars move 24/7 and instantaneously. And so this was a great product that was just really starting to roll and starting to really take off, and we were excited about the prospects of it.
So I didn't really get much out of Scott as much as I wanted to about some of the battle wounds that you guys had gone through. Can you just take us through a bit of Operation Choke Point on Silvergate, on what happened, being inside, having your funds frozen, having accounts frozen, customers panicking? What happened? Like, can you just give us like a on the ground quick anecdote as to kind of like what that was like?
Well, what I can say to you is during that time, there was obviously a lot of uncertainty in the industry as a whole because of what was happening with SVB. And there was clearly a bankruptcy problem going on there. And the FDIC came out and said, hey, we're only going to cover 30 cents on the dollar of every single SVB depositor funds. And when that happened, there was a tremendous panic in the marketplace. SVB is very much connected to the investor community, very much connected to the Silicon Valley VCs, and that drove a tremendous panic through the marketplace. And so what that really kind of kicked off was a lot of questioning of regional banks that have been so good at servicing the investor community and building out funds and capabilities and products and services for them that it really started this questions about what was happening. Frankly, from our standpoint, we received a lot of funds at that point in time. A lot of funds were moving from particularly California regional banks into Signature at the time. And so it was really much a flight, what we thought was a flight to quality from our standpoint. But other industries were obviously questioning what was going on. They knew our commitment and our interest in our products and services for digital assets. And so we also, just like any other bank, there was a lot of questions on what our balance sheet looked like. We put out statements. We're very clear about our solvency and what that looked like. But ultimately, when you're in a situation as a traditional bank, you have a lender of last resort because you have, 10 cents to 8 cents, depending upon what your capital reserves are. For every dollar, you have in deposits, you only have 8 to 10 cents in actual cash. And the rest of it's in some sort of investment portfolio that has been defined by the investment committee. And so you're limited on what your capital really is. And so, depositors are always looking for that. So, they started asking questions, but we were in a great solvency position, and we were ready. We had a very strong loan portfolio, and we're ready to borrow against that. And, the word will ultimately come out on how this all kind of came down. But ultimately, we were denied that lending opportunity or that borrowing opportunity to solve the capital problem or liquidity problem for our clients. It was not a capital problem; it was a liquidity problem. And so that in and of itself tells you where that policies and overreach by different regulators can decide what businesses win or lose.
Yeah. That's insane, right? Yeah, it is. It's fascinating, and it's indicative of centralized control, centralized power, and I think there are lessons to learn as a result of this. And you mentioned that now this was a result of Signet. You and Scott are now working on N3XT. And my takeaway when I initially met the fella at your firm is that this is a full reserve bank, and so this is, as I understand it, fundamentally different from everything that you guys had in your previous venture. Maybe you can just tell us, specifically the learnings that ultimately led you to this structure.
Sure. So I think two things. One, we chose a state regulated path. We wanted to align to a state that had perseverance, experience, knowledge in digital assets, and was committed to it. And we wanted to see that to the point of perseverance over the long haul. That's why we went with the Wyoming, State Banking Association, State Banking Division, because they had shown a commitment to this space and wanted to find and present ideas that were going to challenge and rethink financial services. We love that. We appreciated that. That was very important to us. Being at the state level, we also saw that comparatively to the federal level, there was a lot of volatility year to year, or not year to year necessarily, but administration to administration on how they looked at things. And so as one administration comes and another administration goes, you start to see policy changes or philosophical changes as it relates to the things that we cared about, which was innovation in digital assets. And we felt that was just too great of a risk. That's why we went state. Second piece, you mentioned it, was full reserve. Going back to my previous statement, a lender of last resort is not something we wanted to subject our clients to. We wanted them to always know that their funds were available and ready for their use whenever they needed. It was never a question on us, untying it or unencumbering it from a loan or some sort of construction project, things like that. We wanted them to know that their liquidity, their funds were always available. The bank was always going to be solvent. And when you think about it, the way a traditional bank works, if one client in one industry has a bad day, that starts to have a contagion effect.
Right.
And that contagion effect leads to escalation and the run on the bank concept. That's what concentration risk is. In our world, we don't have that problem. Clients are always protected and they're always isolated from other people's bad problems or bad situations. They are protected at all times.
I think the question I'm left with as a result of this is how do you guys make money? Because the traditional structure of doing things is banks are going to take your deposits and then they're going to go lend them out. They're going to earn interest on those. And then when you need your money, you're going to come back. And as long as there's a healthy flow, and to your point, no one has a terribly bad day, everything is right in the world. Or if there's a bad day, a lender of last resort steps in. In this world, you're fully reserved. 24/7 liquidity is available at all times for all depositors. So you're not lending out, customer deposits. How do you make money?
Well, we do put the funds in a safe, secure manner because FDIC insurance has proven to be less than reliable. Unless there is a perceived catastrophe that they create. So from our perspective, what we've done is we've said, okay, we're going to hold some of it in cash. We're going to hold a lot of it in short-term T-bills, 1 to 3 months or less. And in that world, everything is a T+0 cash-in-kind transaction. So you can always get, and there's always liquidity in that marketplace, so you can always get your money when necessary against those T-bills. And so we're making money off the interest associated with those T-bills. That's part of the model. Part of the promise is that we're giving you a tech-forward platform that gives you assurance and security at all times. You can legally and transparently see what you have, and you know what our overall holdings are. So when you're starting to evaluate the risk with a bank, you can look at us and realize that, hey, we're a safe and sound institution. We know what we have at all times. And so we're selling the promise of security, safety, but also a tech-forward platform that allows people to have to unlock their money. Some of the reasons you talked about people making yield on their deposits is because the money gets locked up in ways that they can't get access to it. We're changing that. We feel like the concept of people working for the bank is changing, and it really should be the bank working for its customers and its clients. And I mean, I maybe a kind of a funny way of saying it, but really, when you put your money at a bank, you're actually buying into a blind hedge fund because you don't know what particular investments they're making at all times. That only comes out maybe with a little bit of transparency once a quarter at best, and then if you can really see, you're really not sure where all that really kind of aligns to what investment decisions or what level of risk they've taken. You just don't know.
There's this big picture transition happening right now, and it's a combination of banking and stable coins. And this fully reserved concept is essentially this narrow banking concept, and you at N3XT have chosen this path. At the same time, you've got this digital dollar, this tokenized deposit. Banks put up quite a fight around the Clarity Act. They still are, and part of the reason is because they're cautioning the entire world around this capital flight that could take place if stablecoins are truly brought into the regulatory environment and treated as cash. I take it that N3XT has essentially leapfrogged all of this, has separated itself from the traditional banks and said, all of this is inevitable. There's no point in really fighting it. You've gone and you've tokenized the deposits. You're on the forefront of this technology. And now you're saying to yourself, we have the potential. The world's going to go in this direction anyway. We have the potential to now be a leader and a pioneer in it. Do you see more banks going in a narrow bank direction and taking tokenized deposits and stablecoins along with it? And how do you see the banking system transitioning or evolving as a result of this? Is it capital flight out? Do reserve factors compress? What happens in that world?
So a lot wrapped up in that, and a great question or questions. So let me start with the inevitable. Banks in the future are going to look more like me than I do like them. And let me tell you why. If you really kind of break it down, if you believe in the thesis that payments are moving towards instant settlement across whatever asset flow, asset class, or asset type we're going to create, that's inevitable, that's expected, then if you believe that kind of thesis, then the banks have to do one or two things. They either have to hold more capital in reserve to deal with the mobility of money to ensure that the run on the bank doesn't happen, or they have to borrow more against their lending portfolio. Either one is going to lower their net interest margin. So the conclusion is, I lower my net interest margin, I either have to go reset expectations with the street, the people, my investors, or I have to invest at a higher risk level with a smaller pool of funds. Neither one's a really great outcome. Think about, you don't want to take more risk, but those that are now resetting expectations, they're going to have to introduce new technology. They're going to have to introduce new models. They're going to have to cut costs. They're going to have to rethink their entire operations. And we know traditional banks have not really been what I would say the leading firms in doing those kind of things.
Not the most
And so
nimble.
what we believe is banks are going to look more like us in the future, decoupling what will be the payment capital, working capital preservation component of a client's relationship from the lending component. And as those things decouple, we think there is actually a safer alternative for people when it comes to holding their money. But one of the questions that is posed in the Clarity Act a lot of times, and the yield question, is the flight of deposits into stablecoins is fundamentally missing the point. The banks have missed the fact that a younger generation, a digital generation, has a different relationship to their money. They expect their money to be with them, not necessarily where you have to go find it. And at traditional banks, you have to go find it. And with the new concepts of the neobanks, stablecoins, other things, the money comes with you. It's a part of your entertainment applications. It's a part of your friend applications.
It's
money is just
embedded into everything.
ubiquitous in everything.
Yeah.
And that's what they expect. And so it's not about stablecoins taking over the world or taking over deposits. It's about the fact they've missed fundamentally what clients and consumers want. And so that change is what's really driving it, not the fact that it's stablecoins. Stablecoins are an outcome of the banks missing the boat rather than stablecoins creating this deposit flight.
Yeah. And so you guys are able to stay like very, very, from a conversation with Scott, this kind of digital dollar enables you guys to also have another breadth of business model from your B2B kind of perspective, but also really just like a better user experience and a better experience than people are traditionally used to with a Wells Fargo or JP Morgan or whatever it is.
Yeah, I mean, what we believe is that we're a bank for builders. We want the innovators to start creating these ideas on top of using U.S. dollars as the mechanism to move funds and move value between people. I look at the world very simply. Everything's a trade. There's a value for asset transfer. It is always the case. If you go down to the bodega in New York City, you're going down there, you're buying something, they're giving you the asset, you're giving the value, whatever that may be, through whatever mechanism. And that transaction is fundamental to all the things that we're doing. What we're saying is that the value for asset transactions should be synchronized and should be consistent on timing versus waiting in elongated periods. And the more we do that, the better our economy works, and more importantly, the better your cash flow projections as a business works, and also your expectation on when the assurances of when funds are going to show up. Because we can settle funds within seconds, where you might have a transaction coming from overseas that could take days, if not weeks, to go through the existing rails. And so we're compressing that time of risk and uncertainty to a level of certainty by using the U.S. dollar, which should be something that we want to support as a country and an economic system.
Yeah. On the train today, on that note, on this expansion of kind of new primitives and innovation, just better experience. I saw an ad for Mercury. They're like an upcoming neobank. They're quite large, and Erebor is obviously growing quite a bit. I think that is seemingly sucking up the mind share of like this new era of banking. How do you think about what you guys are building in relation to what Mercury and Erebor are doing?
Yeah. So I think there are two different things. So with Mercury, very, very much geared towards the digital generation from a consumer perspective. We're institutional B2B only. So we have a different construct of who we're actually targeting. how I would kind of combine it. We want to be the same technology level that a Mercury is, but bring it to institutions. But with that, provide them a level of assurance and confidence that their funds are not being commingled into other risky assets or risky businesses. Because a lot of times the consumer side of this gets to be kind of the questionable piece. What is the default rates on various lending products out there? And so what we don't want is a particular institution to be are bothered by what's happening in a different sector. And so we're trying to give them that assurance, that confidence. So very different than a different target than what Mercury, but believe very heavily in their tech focus.
But my understanding of Mercury is that it's very friendly to crypto businesses, and it's a really great banking option for crypto businesses. Is that not like directly tied to what you guys are trying to achieve as well?
I think what we are targeting is a lot of the capital markets side of the crypto businesses. So think in terms of the OTC trades, the stablecoin liquidity plays. I mean, the market has changed dramatically. And so what we are servicing are those trading companies that are really focusing on, hey, I've got a particular, it's a new FX. So the new FX, so a stablecoin for dollars, or a stablecoin or a Bitcoin for dollars, or it could be some sort of other conversion if you're getting into a particular trade. But ultimately, the difference, I think, is going to be we're focused on the capital markets component of building out that infrastructure. Folks like Mercury, we should be working together on those kind of things. I don't think there's any separation between us, really, because we have a different focus and a different model. I think they do a lot in the payment space for the individual consumer side. So think in terms of cards and PSPs to other types of ACH offerings, which are not the area of focus for us. We're focused on creating large transactional assurances between our institutional clients.
Yeah. And you're mentioning compressing the time that it takes to move between some of these. And on chain, we've called these atomic swaps. Sometimes they're not atomic when we're going across different things, but ultimately that time is compressing. There was a report from Citibank that said we're moving towards a world that is going more in this atomic swap direction. Obviously, we're talking about this relative to cash and cash-like instruments. Citibank was applying this to tokenized equities and was talking about how there's a world where the US dollar gets removed from this equation because you can go directly from equity to equity and we don't need to settle in the dollar. How disruptive is that? Because that to me poses a potential risk to a lot of the use case of the dollar as a reserve currency if we don't need a reserve currency. Just generally your reaction to this, if you think Citi's thinking about this the right way, and maybe some misconceptions that could help clarify this.
Well, I think it's an interesting perspective, and I think it's something that will play out. I don't think it's going to be the predominant way transactions occur over time. People still need that touchstone of something that has value to them that they can actually use in a ubiquitous manner, and that still is the dollar. Now, if I were to say to you, okay, I want Amazon for Anthropic shares or whatever shares, we can make a trade on that. We can come to a price. Well, that price is still always a little bit hard to kind of negotiate because we don't have that kind of anchor by which we do that. We're still going to use the dollar to anchor that transaction. And so your dollar is still going to play a role there in anchoring these transactions for sure. But whether or not it gets traded, ultimately what's going to happen is we could slow down or create efficiencies by doing those transactions directly. But the idea of moving people to between those into liquidity pools that kind of find that type of level or that level of uniqueness in the transaction is kind of hard. Yeah. I think being able to go back to the anchor point, the dollar, allows us for someone that needs to get out of Amazon right away versus trying to find someone that I need to get into in Shell. Those are kind of hard to find. It's a lot harder finding that liquidity. So using the fiat currency, I think, is a little bit important to create efficiency in the marketplace.
Yeah. Jeffrey, last question that I have for you is related to a conversation we were having earlier today about passing a lot of the efficiency and the savings back to the depositor. Right now banks pay half a basis point if you're lucky on these savings, accounts and deposits and things. as we're tokenizing more of these assets, they become more available, more liquid, more transferable. It seems as if they could help to increase the amount of yield that we're paying on some of these deposits. The example earlier was Apollo's A credit is paying 8%. There could be neobanks. Maybe we don't want to call them banks per se, but places where you could deposit your funds with liquidity and get 8% on your deposits. How likely is it that we increase the base savings rate for depositors in America to, high single-digit percentiles?
Yeah, I hope we do. And back to your original piece, what the banks are paying today, you're getting a pittance for the money that you're putting in, but you're taking on a lot of risk for that little reward. So there is a risk-reward question that has not been applied to banks traditionally that we need to start thinking about. What we believe is that we want clients' working capital to be safe and sound and secure. We want their yield capital to be put into good use where it can actually find the best return for their investment and the best outcome. And that may be in creative solutions that other people provide. We want to enable that. We're not there to compete with that. We're there to actually make sure that they can get to that as fast as possible. And so having that quick movement saves, one, it allows the individual company to get to yield-bearing activities faster and allows the yield-creating company to get access to those dollars and do something with it as fast as possible.
Yeah.
So efficiency is of the importance there. We want to do things that start to create yield on an hour-by-hour basis, not just a day kind of framework.
Or monthly or whatever
right.
it is, yeah.
Right, and so how do we do that? We do that by being able to move the value component as fast as possible and assurance that it's going to be there versus the risk that sits out there today.
Yeah, it makes a lot of sense what you're saying. The separation of working capital and yield capital, the rise of narrow banking and tokenized deposits. Jeff, thanks so much for coming here today and spending some time with us.
Hope you appreciate it. Yeah, thanks so much.
Yeah.
Will.
Thanks, Jeff.
All right,
See you next time. Thanks. Oh yeah, let's do it.
Yeah, come
got
on,
the
Jeff, get in
Polaroid.
there. It's a classic one here.
All right.
All right, ready? 3, 2, 1. Nice.
Very good.
You have to sign it for us?
Thanks, man.
You don't mind?
Alrighty, guys, we got a couple more left. We'll be right back with a quick break. Might have a special guest for you guys. See you guys in just a second. you guys, we are back here in Stamford, Connecticut at the Digital Forum Future Fest. Been a great event so far. Here with Christopher Hetner. Chris, welcome to the show.
Good to see you, man. How are you?
Good to have you, man.
Yeah,
I
thanks for
appreciate
coming.
it.
A lot going on in the world of AI, in the world of cyber. I'll tell you that, man. Man, give us a quick rundown. What has the last 6-12 months been like for you? You've been very busy. What have you been working on? What are you most excited about?
So it's definitely an arms race, right?
Yeah.
You know, just when we thought that we had this under control, suddenly some new type of platform is introduced. Now we're seeing, Mythos and all these other frontier-based AI platforms that are taking down companies within minutes. Like 3 years ago, when I was a global chief information security officer, the average attack time frame would be probably around 3 months before the adversary would assess your situation, conduct a reconnaissance, and then infiltrate and perform the cyber attack. Now, with the introduction of these agentic AI platforms, it's happening within minutes. And so, unfortunately, we as a community are still operating based on the threats that we've seen 20 years ago. So we need to retool for speed, not only at the operational level, right? Whether we're dealing with frontline analysts or security operations centers folks or folks that are running firewalls, due diligence, but that needs to bubble up to the board of directors. And so a lot of my focus now is to ensure that the governance frameworks and the risk management capabilities at the board level, CEO level, all the way down to the operational level is revamped for speed. And unfortunately, we're not there.
Yeah. Well, these things are moving incredibly fast. And so how do you do that? It sounds as if you're restructuring companies' organizational components from almost from the highest levels all the way down to the people that are on the ground. You're working with these CEOs, you're working with these companies, these board members. What does it take? A lot of times these are large companies. It takes a lot of time to restructure these things. But when you're talking through some of these strategies, what have you found is most effective?
Well, you have to speak the language of the board, right? If you enter the boardroom talking about the bits and bytes and the deep technical dynamics of artificial intelligence, supply chain risk, AI, it completely gets lost in translation. So you've got to contextualize that language to what does it mean to our business? How is it going to maintain our operational resilience? And then what's our financial impact? In fact, that's an approach that we've taken for our board community at the National Association of Corporate Directors. We support a community of about 25,000 members now, and I also sit on 3 boards, so I have to eat my own dog food, right? But you've got to be in a position to really operationalize this for speed and really bring that business context. And that's something that we're leading with our community, across the boardroom community. We're bringing in peer benchmarking analysis. So, if you're on the board of an insurance company, you're on the board of a retailer, you have very distinct contours in terms of your operating model, right? Some businesses are concentrated, some businesses are distributed. So we bring in that context based on how the threats are impacting your industry segment, where the threats are most likely going to be realized in terms of a financial loss, and then what do you do about it? The analogy is like, you go to a cardiologist, say, hey, I've got 80% blockage here, we'll see you in a year. No, we're going to prescribe medication. You're going to stop eating McDonald's every day. You're going to cut back on smoking. You're going to exercise. So we prescribe how to deploy capital and resources in such a way that reduces that risk over time.
For AI, it sounds as if the prescription is to cut labor, to lay off people, to maybe deploy more capital and resources towards these models rather than deploying it towards human capital. Is this a common prescription that you're finding to help cope with some of the adjustments in the way that these businesses are becoming reshaped and the industries around them? What have you seen in this? What is the reaction when you're in a boardroom, and have you found yourself in these situations and you're telling potentially the leaders of a company, hey, it's in your financial best interest to lay off 20% of your workforce?
This is happening in real time. And so here's what concerns me. The investor community, right, the street, is insisting that everybody become an AI company, whether you're a pure tech play, pure software play, right? Now we're even bleeding into the industrials, whether it be healthcare, manufacturing, you have to deploy AI. So what's happening is the investor community is insisting that you deploy AI. It sits on the board agenda. They push it down to the CEO. and lands in the lap of the operators, the CIO, the chief information security officer, and they're looking around. It's like, we don't have any AI capability. And unfortunately, before we get to this other side of greatness in terms of AI adoption, we're going to see somewhere ballpark of about 75% failure rates. We're even seeing bots that are being deployed that have gone rogue, that are spitting out data, exposing data inappropriately. So, and as mentioned before, the ability to monitor that agentic capability is not in place because we're still using manual process. So the only way to manage the risk and govern this agentic capability is to create agents. So we're almost having an agentic to agentic dynamic. You know, we're talking about Terminator here, guys.
Yeah, I know.
And that segment of the security industry is actually booming because you have to now retool. You have to create agents that are going to monitor agents. But unfortunately, again, we're going to see an AI minefield before we get to the other side.
And you did some work with the Obama administration, a little bit with the Trump administration. What about with governments? What does the adoption curve look like as it pertains to private companies versus public companies and governments? What's the speed of adoption? What is their openness? Right, because there's a lot of talk that governments have had access to these tools for a lot longer than the public knows, and that they've hidden them and they've worked privately with these intelligence companies and they use them for a lot of their different intelligence needs. What's kind of the state there on the government side?
Well, historically, governments across the world have used cyber as a weapon, right? And there's historically they've actively been engaged with exploits, right? And those exploits are conducted by specific companies. Think of it as creating a weapon. I'm going to sell you the rights to that weapon, you specifically as a government. That dynamic has flipped because of the agentic, AI capability that's widespread. There's countries throughout the world that are enhancing computing power to process a lot of this data quickly. Now we're talking about post-quantum readiness, right? The ability to decrypt and not only the data that's secured, but also the flow. So think about it, you as a financial institution, you're clearing and settling $100 million a day. I'll make it up between two parties. That's all encrypted. That's layered in terms of control activity. Here comes post-quantum, right? And the ability to decrypt and potentially disrupt that. So the governments have always been forward-leaning. The administration recently issued an executive order on AI security this week. And what we're trying to do is strike the balance between innovation, right? Don't stifle innovation, allow AI to thrive, but also balance it with risk management practices. And so the executive order outlines that fairly clearly across critical infrastructure, across various governments, including Department of War, Department of Homeland Security. But putting government aside, the reality, particularly within the US, is roughly 85% of critical infrastructure is owned and operated by the private sector. And so we've got to create an incentive pull to pull these folks in that are running multi-billion-dollar companies, say, you've got to invest into your defenses. You need to understand where your AI inventory sits, what's your supply chain dependency, and really hit this hard in terms of business, operational, financial impact in order to drive that risk reduction, and then have this collaboration with government.
Chris, man, I know you're on a tight schedule here.
Yeah.
Last thing for us, what is your favorite thing to do with AI?
I essentially serves as an assistant, right? A lot of it's research, collating data, but it's you've got to balance that. You've got to have that quality check, what we call human in the loop.
Right.
But the days when I was in the corporate America building PowerPoints for like 3 hours and sorting through, research data or threat data, those days are over. Like I'm working with companies that a traditional threat analyst would take a report, let's call it 20 pages, take them like 4 or 5 hours to determine, okay, so here are the threats that we should focus on. There's agents now that are doing this task within minutes. And so right now is really the need for speed.
Yeah. Chris, thanks, man.
Yeah.
All right, man.
Time, buddy.
Good to see you,
Appreciate
man.
you coming on.
I
Thanks.
appreciate it, guys.
Yeah.
Take care.
Awesome. Quick Polaroid before you go, Chris. Chris, Come back down here for just a quick sec, buddy. Go Knicks.
Go
Knicks,
Knicks.
baby.
Let's
There
go,
it is.
baby. 1-0, baby. Go Knicks. Big game Friday. Come back.
Is it gonna be posted or streamed online?
Yeah, it was just live. It'll be streamed. It'll be posted. It'll be clipped. Atano got you. Guys, we'll be right back with our next guest.
Money, power, I'm big, 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 but I'm big. I'm right big, 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 but I'm big. Money, power, I'm big, 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 but I'm big. We get deep, you know we get deep. You know we get deep, we get deep. You know we get deep. We get deep. We get deep. We get deep. You know we get deep.
Alrighty, guys, welcome back to Connecticut. We are at the UCONN Stamford campus today with David Hendrickson, one of the AI implementation experts into your favorite stocks that you hold in any big public company. This guy is your guy. David, welcome to the show, man.
Welcome. Good to see you, Andy. Good to see you, Robbie. It might be an overstatement, but happy to try and field any questions.
There we go.
I don't want to get over my skis or oversell. You said it, I didn't.
Man, I mean, so many places to start. I think when it comes to implementing AI into boards, into businesses, there's a lot of education that is required. There's a lot of education. There's a gap of education, and there's questions about literacy, accountability about how these systems will be implemented. Maybe just give us like a 30,000-foot view here of the actual state of progress in your own work, what you are doing with these companies. Just kind of like give us an overview as to the actual adoption of AI tools in these large companies' boards.
Sure. It's a deep question, but I'll do my best. In terms of people being on a board of directors, the sort of three pillars are duty of care, actively participating in board meetings, reviewing financial records, and making informed, diligent decisions. Then the second pillar is you've got duty of loyalty, and that's always putting the interests of the organization ahead of personal gain or competing business ventures. And the last thing is duty of obedience, and that's ensuring the company operates in a compliance manner with all relevant laws, state, local, federal, could be international, as well as industry regulations and its own internal bylaws, because all boards have bylaws by which they have to operate. But if I may, to take you back a little bit, you're a lot younger than I am, but and I wasn't born in the 1800s, but the second industrial revolution took place from roughly 1870 to 1890. Why do I bring that up? There are a number of economists that opine that that economic revolution was bigger and more dramatic than what we're going through now. So if you'll permit me, I just want to share some facts. So the 2 decades spanning 1870 to 1890 unleashed an unprecedented spike in epic inventing. So AI's been invented. We'll come back to that. We had the internet before that. We had the PC. We have the mobile phone, blah, blah, blah. But in those 20 years of 1870 to 1890, you had electricity was born, the telephone was born, the internal combustion engine was born, modern plumbing and widespread steel production, which was known as a Bessemer model, and that actually collapsed the time to create steel. So what ended up happening is the GDP, gross domestic product, it increased threefold in that period of time. And it also, because now Americans had what we just mentioned, those technological innovations, the invention of the weekend came about, the invention of the 5-day work, the 8-hour 5-day work week came about.
Sir Alex.
And modern retirement stemmed from that, and you had all sorts of efficiency gains. So, okay, that's good. That was then, this is now. What's AI all about? AI is obviously an incredibly powerful general purpose technology, but its impact is in a narrower scope compared to the massive physical and infrastructure overhauls of that 1870 to 1890 period. And while the 19th century innovations physically connected the globe and expanded lifespans and revolutionized agriculture and manufacturing, AI, this is the key thing, AI primarily automates cognitive and digital tasks. So AI is maturing much faster than physical technology revolutions ever did. If you look at the first industrial revolution, the second one I just commented about, but AI operates as a tool augmenting white collar and digital labor rather than fundamentally changing basic human needs like illumination, sanitation, and transportation. So a big difference there.
Yeah, it is. And I mean, we had a conversation about the robotics side of things and how, the LLM capability in the digital form has certain implications, but clearly, as you've laid out, putting that in the physical form has another set of implications from progress, from innovation. So if these facts are true, which clearly they are, why are we calling this the biggest invention since the inception of the human race itself? What are we missing here, David?
Well, they're probably calling that because you don't know what you don't know. And when you don't know things, fear is a good motivator. I hosted a panel today on AI governance, and one of my panelists was Byron Laughlin, who heads up global advisory services at NASDAQ. And he and Mark Thompson just penned a new book called CEO Ready, What You Need to Know to Get the Job and to Keep the Job. But Byron and I are birds of a feather in that we like the phrase, presently there is artificial intelligence and there's artificial ignorance. You get to choose. And if you look at most board members, if you look at their natural age, and if you look at their career-to-date experience, they didn't grow up with AI.
No.
AI is a new invention. And I'll take you back to the IBM PC because I was on the team that did the commercial launch and announcement of the IBM PC. Wow. And I was your age or maybe a little bit younger. I was a young guy at the time. And I remember a CEO saying, "Young man, are you telling me that that box," and they called it a box, "that box can go into a mainframe computer. You can download," you'll never believe this, but this is true, "you're able to download information, financial information, product information, and you can put it on that floppy disk," because when PCs first came out, it was a floppy disk. And I said, "Yes, sir, that's correct." And that was a correct answer. They immediately left the ballroom. This would be a Ritz-Carlton or a Four Seasons, and that's back in the days where we had pay telephones. This is pre-mobile phones. And they were calling in to say, "Don't buy IBM." And so I overheard that. I had to pull them aside, and I said, "Qu'est-ce que c'est? Why are you saying this?" And they said, "Well, if you can download this onto a floppy disk, you can walk across the street to my competitor, and you're going to give them all our financial information, all our product information." Why do I tell you that long-winded story? For PCs, the biggest concern, security, integrity, and control of information. Security, integrity, control of information. Fast forward to the internet. When the internet happened, guess what was happening? Security, integrity, and control of information. And nobody knew what the internet could do or not do, and no one knew that pornography would become the financial backbone of the internet. And now we have this thing called artificial intelligence. What are people concerned about? Security, integrity, and control of information. So we're probably in the first or second inning of AI, and because we don't know what it is or what it will evolve to, it's a whoop, 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 whoop. Everybody's getting nervous. And it's like anything else in life. You have to look for the benefits of it, and you also have to look for where do we need to put guardrails? When does the government get involved? Should the government get involved? Or do we as individuals and as corporations and as governments come together and determine what are the best guardrails to have in place?
These are big questions. I mean, these are questions that every facet of business and policy these days. This is, a big question when it comes to government and the laws and regulations that we're putting in place as to how we regulate AI. Every company is an AI company now. Every company has an AI strategy, and they're faced with these same questions. And so, as we're thinking through these, we're faced with a couple of different paths. In America, we're talking about regulating this potentially at a state level or federal level. Otherwise, we get fragmented. There's also the open source conversation. China's got their policy as it relates to AI. And so given that you oversee a large swath of companies and not directly oversee, but you provide advice, you're an advisor to boardrooms of several of these companies. Is there a one-size-fits-all solution here as to what you're prescribing to these companies? Or do you really have to look inside at the nuts and bolts, do some analysis and say, okay, in your situation, this makes sense. You should treat AI like this. That is obviously the much harder path, but obviously in life, sometimes the right path is the hard path. What is your approach?
Well, again, it's a great question. When I look at the two of you, you're both wearing nice sport coats. And when you said one size fits all, could you wear his and could he wear yours?
This is actually not his. He forgot his. And so our lovely Atan had to lend his sport coat.
And it did fit.
But it looks like a great fit, custom fit.
Excellent, very sartorial in your taste. It's an excellent sport coat. But the reason I use that analogy is one size does not fit all. So if you took your sport coat off, if he took his borrowed sport coat off and put it on someone else, it's probably not going to fit like a glove. So there's an old English phrase, horses for courses. It gets down to each company has to look at its strategy, and if it's a product company or if it's both a product and a service company, and how do we employ and deploy AI? And it's a great question. On the board that we had, the panel we had today, I told you we had Byron, who heads up board service for NASDAQ, and he consults to hundreds of boards, and his book is a great book. I've got a copy for both of you if you haven't had one yet. We'll get you a copy
Please.
today. It's already pre-signed. I was just with him. He had to go to the airport. But we also had Joan Amble, and Joan's on the board of Zurich Financial. She's on the board of Booz Allen Hamilton. She's on the board of Spire, and she was previously on the board of directors at SiriusXM Satellite and also Brown Forman, Consumer Products Goods Company. And then she's also on the advisory council for the PCAOB out of Washington, D.C., and that's probably the largest regulatory entity. And then we also had Robin Elkowitz, and Robin was general counsel and corporate secretary to Citizens Financial. Citizens Financial was private when she joined. When it went through its initial public offering, it was the biggest IPO in financial services history. And so the reason I had the three of them there, Joan sits on boards, but she's also been chair of audit committees, on compensation committees, on nominating and governance committee. The most important committee in any board is the audit committee. And Robin is the one from a legal beagle standpoint, if I can use that term, and I say it in the most affectionate and compelling way. She has to make sure, to the earlier point, that the board and the company's acting in an ethical manner. And then you've got Byron, who sits down with boards and he actually assesses. If you're a board member, Robbie, if you're a board member, he assesses you on an annual basis. And so you need that triumvirate really to make sure that you're putting the best strategy forward. And out of that comes your AI strategy. And there are many people that try and push things into audit because it's the most important committee, but it's typically the most overtaxed committee. And now there's, to get back to your question, there's a lot of debate. Should there be a new committee that embraces AI, or do you stuff it in one of the top three committees that you have, which is, again, audit, compensation, and nominating and governance? And nominating and governance, as you would think, we nominate new members to come on the board, and we have to concern ourselves with all the governance issues. What do we have to do for 10Qs, 10Ks? Are we being compliant with the reporting? What are we doing for shareholders? Blah, 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 blah. Audit, is the definition of audit. It's the numbers. It's the beeswax of the business.
Wow.
And so is that like accountability, predictability, auditability? Like, is that safety component? Is that the biggest pushback that you get? Like what is the biggest pushback when you talk to these people about implementing these tools in their work? What is that? What is the pushback? Is it a fear of disrupting of their job, of their organizational structure? Is it this integrity, misplacing of information? Like what is this pushback that you're receiving?
Sure. It's not necessarily pushback, it's an active conversation, because the sort of vogue term right now is AI fluency. And a board's key responsibility is governance. That's a noun. It's governance. It's not operating the business. And when you're on the board, there's a phrase that we use, noses in, fingers out. You guys are the operators. You're in the C-suite. You're doing the business day to day. You're doing this podcast. You've got your technical team. You may have your sales team. You may have several other teams. You're going to know your business better than I do day in and day out. A board member is more concerned with the future strategy, how we're going to grow the business, et cetera. So there's probably not a whole lot I can tell you on the day-to-day of your operations. But to get you from point A to point B, what's the strategy? What's the milestones? And so with AI, what we talk about is AI fluency. But now boards are shifting. Governance is a noun, but if you put another noun in front of governance, it's technology. So boards now have to shift from just being governance to technology governance. Because if we went out on Summer Street here in Stanford and opened up a fire hydrant, you've heard the proverbial phrase of it's like drinking out of a fire hydrant, we'd be blown away. That's what AI is right now. So how do you harness AI so it's simpatico with the strategy of the company and where you're trying to take it? And it gets back to, one suit size, one sport coat. Yeah. It's not one size fits all, and it's got to be individually tailored. And those things take time. And Chris, who was just recently here, you need to bring in external people as well as your internal people, because it's a new technology. And there was a book by Michael Lewis a number of years ago, The New Thing. With a previous firm that I was with, we placed a guy by the name of Eric Schmidt that went into a little unknown company called Google, and we think, everybody knows what Google is today. And he did just fine, thank you very much, as did Google. But those were the burgeoning days, the startup days of the whole search engine business. We're kind of in the same place today.
Yeah. I was previously unaware of the whole board complex, as a lot of the work that we do is speaking with a lot of the, it's a lot of startups, it's a lot of private companies, and they are, and especially in the decentralized kind of like crypto network world, a lot of them have taken a more collective approach to governance rather than kind of electing, the board, if you will. But it sounds as if there's this governance board is responsible for overseeing the business, as you're saying, governance with respect to that. And it sounds like a lot of what you're doing is making sure that you build the business in a sustainable way. And I'm just kind of in awe of the way in which you're able to help guide a business despite maybe a lack of fluency in a particular area for those who are on the board. Maybe they aren't the most technical and deep into AI or some of these more technical concepts, but the path that these businesses tend to take does show enough similarities where these governance structures are able to coalesce and manifest themselves such that they do, progress through the stages of these businesses despite very, very complex inner workings. And so I'm just, it's a very rich experience, I'm sure, as you see more and more companies progress through these levels of scale.
Yeah, I couldn't agree with you more.
David, kind of last thing from me here. What is your ambition for what you're doing with implementation of AI into boards? Like, what would you, a couple years, 5 years down the line, what do you want to look back and be like, this is what we accomplished with our clients?
Sure. No, great question. I think it's to educate, to elevate, and empower. And what do I mean by that? There's a company sitting across the hallway from us called Next Generation Governance Group. And what that entity concerns itself with, be good for you to talk to them, what that entity concerns itself with is AI governance. And they've created modules. You can go out to Northwestern, you can go to MIT, you can go to Harvard, you can go to a lot of places for 6 months and spend $28,000, all great institutions. But board members don't have that time. And there's a shortage of time for everyone. So what they've done is to increase the AI fluency is put together video modules that are 15 to 18 minutes long, because we found from all sorts of science and research that's about the average attention span. But what's great about something like that is you can access it 24/7, 365. You don't have to fly somewhere to a campus and take a class, et cetera. So it's entities like that that are helping others get educated. And that's not to be dismissive of all the great schools I just mentioned, where you could go spend 6 months and get a certificate, or for that matter, get a master's degree. But it's getting people educated, getting people comfortable. And thank you both. It's things like this of socializing it and talking about it, because, as Dr. Martin Luther King said, we don't know what the future holds, but we do know who holds the future. And it's all of you gentlemen in this room and others outside of this room. So if we're not helping one another get educated on things and live in a harmonious way, we're not being good folks.
Yeah, that is the essence of this show.
Man. Absolutely. Give him a couple of applauses.
We appreciate you coming on. Thanks so much.
For coming on.
Yeah.
We have to get a photo with you here as well on the Polaroid, bringing AI to the big businesses worldwide.
Yeah, I don't know if you want to date Tilly, but that's the first AI-generated model.
Create Hollywood's next big star.
Yep, that's Tilly.
Beautiful. Yeah, go ahead and hold that up for the picture. Come on, David.
Tilly, man.
But that was came out last Sunday. So this is Now you've got everybody out in La La Land all mad because Tilly Norwood is, everyone's trying to get her, scripts and everything else, but she doesn't exist. It's an AI, AI actress.
So we'll be right back with our next guest. That is David. This guy came prepared. Thank you, David.
Thank you, Joe. Appreciate it.
Absolutely. Thank you.
No, thank you.
Alrighty, guys, we are back here in Stamford, Connecticut at the UCONN campus. Thank you, Rugrat. Awesome segment. The audience wants the book. They don't even know about your book. They're going to find out. We've got Bob Dewey here. Bob, great to have you, man.
Thank you very much.
Cheers, man.
Andy,
Cheers.
Absolutely. Thanks for coming
How's
on.
the event
Thank
treating you?
It's great. Great,
Good.
as always.
Fun time?
The panels are particularly good today. This
Are
is
they?
about, timeliness, too, about what's going on everywhere.
What has been your takeaways? Because we've been here in this room talking with some very smart intellectual people as well. Have some takeaways ourselves, but I'm curious from the panels outside.
Apparently, Bitcoin price is down.
Is
I learned
it
that
really?
today. Yeah.
Wow.
Yeah. I went to
Yikes.
look at my feed this morning, and AI must know a lot about me, but I noticed that when I looked at all the prices, the Bitcoin price was blanked out.
Oh boy! Oh no, that can't be good.
Yikes.
So Bob, you are the founder and host of Exploring Prosperity podcast newsletter. You examine how real human progress happens, challenges, widespread collapse narratives. I'm curious, we love this. We love this show. We talk to, people all the time. We're constantly updating our mental model and our thesis about how we view the world. I'm curious, as exploring prosperity, it's a big topic. Generally, as you explore prosperity, what have been some of the most effective strategies?
Well, it all came from how pessimistic everybody is about the prospects for the next generation, and it's record levels. It's been pretty much a straight line down since World War II, and yet if you look at all of the indicators, economic indicators for 275 years, which is when economic growth began recurring, it's been relatively a straight line. There have been a couple of depressions along the way that after a 10-year period, almost always you've recovered. And so World War I, World War II, the Civil War, other wars around the world, that hasn't really slowed it down. And so it was a curiosity to me why so many people thought that just suddenly we were going to stop this upward trend. It is mostly economic, and a lot of the pessimism stems from kind of non-economic, standard of living type thinking, even though most measures of standard of living have also increased. So I just thought this is a pretty interesting topic. Should we be as bummed out about the future as we are? And I don't really think so. I don't think we're likely to, stop progressing. And so I get specialists on to talk about the things that make people bummed out. It's not really a political show at all, so the political polarization stuff is obvious to everybody, and I don't do that. But the education system, the loss of confidence in institutions is a big source. Debt and deficits is a big source of pessimism. Climate change is a big source of pessimism. And so I go into those different topics.
And so the loss of confidence in institutions is one that I think a lot of us, especially in this industry, have started to orbit around, because you're right, there's loss of trust in institutions as it pertains to governments, as it pertains to religions. These have been the ways in which these have been the curators of thought, the leaders of the world over the last hundreds of years. Now we are sort of kind of bringing things back to the individual, and we're putting more and more trust into individuals in the sense of social media became more connected, and this has led us to where we are today. And so, I'm curious why you think we've progressed in this direction, despite all the positive economic growth as of the last recent history. Why do we continue to progress in this more pessimistic direction, despite having the institutions that have always been here? They've felt good. It's almost like we know too much for our own good.
I think volatility, disruption, just change in general is a very powerful motivator for humanity, and change has been progressively accelerating.
Yeah.
And cyclically too. If you look at the fourth turning, that idea or any kind of cyclicality, you're going to go through these cycles. And this is the time, at least in the fourth turning type theories, that we're entering that erosion of institutional confidence. And in the past, it's typically wound up in war and changes in society and the emergence of new institutions that gain trust and confidence. But I think that the return to the individual is technology related.
Yeah.
If you go back 50 years, and you don't even have to go back that far, but individuals couldn't really put together something and make a living. And there has been a progression of advanced tools in the hands of individuals like yours and mine, where we can start a media company essentially.
Right.
And you don't need a fleet, you don't need a corporation. And AI, I think, is just a massive accelerant. I think corporations are now going to be competing. They're going to lose the competition of holding people in their companies. And that was generally viewed, and we still talk about jobs today as the most important economic indicator. Jobs are a dependency on corporations for your living. That, I think that those ties are loosening, and that's a great release of human capability and labor.
One of the views on AI is that it's this disruptive technology in a negative way, in the sense of it's disruptive to the human labor force. And U.S. jobless claims as of yesterday came in at new highs for the year. There's another camp that says that AI is the great enabler of prosperity, of the arts, of the return to philosophy. How do you kind of juxtapose these two views into a reconciled, accurate worldview for what the future could look like?
What I've read somewhere a while back, that the greatest unlock of human labor in one technological development was the washing machine.
Wow.
Where, a third of the population that were homemakers washing clothes was suddenly given 4 or 5, 6 hours a day of time to do something. And that's a great example of when technology comes along and makes it's solving problems that waste your time.
Yeah.
And I think that is the narrative that is missing today. These things are, when you apply AI to be able to do things that you had to hire people to do, or a better way of saying it is, I was my first job out of college. I was the first guy at Morgan Stanley to use VisiCalc. There was one PC that was purchased. I happened to stumble across it. It wasn't purchased for anybody. It was sitting there. My job was, I was hired to fill out numbers on a spreadsheet. And I became the spreadsheet guy. So I got put on all the big projects. And that was very exciting. Within 6 months, PCs were everywhere. And there were headlines everywhere about how that's going to wipe out the need for investment banks to have analysts.
The spreadsheet guy's gone.
Totally wrong.
Gone.
Every analyst became so much more powerful. And in many ways, I believe that the LBO craze of the 1980s was driven by the ability to do all this modeling that you could never do before. And so you could be very precise about when you would default on the bank who lent you money to buy the company. But I think that's not a bad analogy to what AI is doing in the language processing and communications.
It's the great washing machine.
Exactly. It's the great unlock.
Grain mixing washing machine.
But
Where's the
individuals
driver
are going to
come into
be
that?
able to compete with companies. Individuals will be able to find gross profit dollars that are coming from corporations. That
We're seeing this today. There's a company out there. It's a little company. It's got like 11 employees, but it's driving billions of dollars of revenue. It's called Hyperliquid, and people describe it as Wall Street's convenience store because it's open 24/7. You can pretty much trade anything on it.
A washer and a dryer on it.
And so there's 11 employees in this company, but it's competing. The Jeff Spector, co-founder of Intercontinental Exchange, owner of the New York Stock Exchange, called this company Hyperliquid bigger than NASDAQ because it is operating at that scale, yet it has 11 employees. And so living in this era where all of us are empowered to a much higher degree, it creates this dynamic where people that are not using this are falling behind, and then the people that are moving ahead.
Yeah.
And so why are people reluctant to use this? Is it a matter of misunderstanding, a matter of confusion? How generally through your work, you're discovering all of these mechanisms to drive prosperity, yet people are seemingly more and more unhappy. There's more out there that's left to be desired.
Just in some context, it's like we have friends that are like of the mind that AI is coming, AGI is coming, UBI is coming. I don't really need to do anything because in 10 years, I'm not going to be working anyway. So I'm just going to call it quits now.
Right.
Yeah, I mean, I would put it in the category of the people who are not using it, the same category of the people that are using it as a crutch. This is a really easy way to get by.
Yeah.
And against your competitors who are working to apply it and accelerate their impact, the gap is going to widen.
Right.
It's, I also don't think that either of these groups is a static group. Because if you ignore it for a while, it doesn't mean you can't suddenly get motivated and, come up with an idea and all of a sudden you're using it and you emerge into the other category. But I think that's going to be probably one of the more noteworthy. We talk about the K curve in the economy.
Mm-hmm.
There's probably going to be a K curve of the motivated against the unmotivated.
Yeah.
Hopefully that will be temporary for anybody that's in the lower category. But the fact is, if you apply your mind to AI, you really multiply your impact.
Yeah. One of the things that is a knock-on effect of the empowerment of the individual and the erosion in our institutions is the lack of collective gathering. Like in institutions, you go to school, everyone goes to school. You go to church, everyone goes to church, and it is this mind meld of everyone in a same common place. Granted, there's 11 people out there working on AI and they're able to build a big company. If I'm trying to do that solo and I'm so locked in, I can use AI to the best of its abilities, I'm going to spend so much time doing this. I'm going to progress, my efforts because I'm highly motivated to use these tools, but I'm going to lose out on so much social cohesion and interactions. Where do you find, and I've been finding myself kind of using the term balance less and harmony more. Where's the harmony between this three-headed trifecta, the individual, the AI tools, and the collective human interaction?
I think that's really personal. And I think that it's timeless. I think that you don't need AI to get lost in creating something, because there are so many examples of people that get lost in creating something, and sometimes it turns out great, sometimes it doesn't. But it's a realization for each person, eventually or not, that I'm out of balance. I need to make sure that I'm investing my time in whatever else it is besides this project that's consuming me. But I think also each person goes through this. I don't know how many friends I have who haven't gone through a period of time where it was a requirement that they spend that kind of dedicated time to doing whatever it is. But it becomes more of a project than a lifestyle for most people. And others just have to deal with the consequences, I guess.
Bob, Dewey, man, Exploring Prosperity. I mean, what a title of a show and of a newsletter. I mean, very, very compelling, and
appreciate it.
Especially for the younger generation who kind of need this optimism. Thank you for spending some time with us. I know it's been a great conference for you. It's been busy here for us. Yeah, I mean,
it's great.
It's been deep and philosophical. Rob's favorite. It's Rob's favorite, man.
I do. I enjoy the philosophical conversations.
Me too. It's great meting you guys.
Yeah, likewise.
Cheers,
Thanks
Bob.
for taking the
Thank
time.
you for coming on, man.
Thank you.
Cheers to you, Bob.
Appreciate it. Yeah, thanks so much.
Guys, 4 hours later. Boys have not done a marathon like this since
It's been a while. Since Bermuda.
It's been a while.
Yeah.
But you know where we'll be tomorrow, live from the tokenization tower, the financial capital of the world, the Nest, 12:30 p.m. Eastern. We have an amazing set of guests for you guys tomorrow. It's been real at the Stamford, Connecticut Future Fest. Rob, sign us off, man.
That's it. Well said. It's been a journey. And if AI lives up to everything that it's supposed to be, then we're going to be having a lot more of these conversations. So I'm excited.
We'll see you guys in the chat tomorrow. Lots to talk about. Stay bullish.